9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Good morning, everyone. Stock futures ticking slightly higher after the S&P 500 notched its 36th record close of the year. And investors are all watching for Thursday's key inflation prints that will help the Fed's calculus surrounding the timing of rate cuts. So let's get to it with the three things that you need to know this Wednesday morning. Hump Day! Yahoo Finance's Jennifer Schonberger, Jared Blickery, and Madison Mills have more.
Fed Chair Jay Powell opened the door for the path to an interest rate cut this year Tuesday when he told U.S. lawmakers during a semi-annual testimony that he was encouraged by evidence of cooler inflation and that more, quote, good data would help get the Fed to where it wants to be. He also said the latest job market data signal conditions have cooled considerably and that the risks of bringing down inflation and cooling the job market are more balanced.
If we loosen policy too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation.
Powell will testify for a second day today on Capitol Hill, this time before the House Financial Services Committee.
And shares of Taiwan Semiconductor are higher this morning after reporting revenue beats on demand for AI chips. The company reported a 40% jump in the revenue in the second quarter from the year prior. Revenue in the month of June alone grew 33% from a year ago, and the numbers come after the stock briefly crossed the $1 trillion valuation mark on Monday. Taiwan Semiconductor has been a big beneficiary of the AI hype driven by Nvidia over the past couple of years. The stock is up nearly 80% so far this year.
And Apple PC shipments are up in a bullish signal for the tech firm ahead of their second quarter earnings. Apple's PC shipments jumped nearly 21% in Q2 from the prior year, seeing the largest growth in PC shipments compared to other companies. That is according to new data from global market firm IDC. Now, overall, the PC market grew 3% in Q2, the second quarter of growth following 7 consecutive quarters of declines, spelling some recovery in the broader PC market.
Fed Chair Jay Powell is in the spotlight again after testifying before the Senate Banking Committee for his semi-annual monetary policy report to Congress on Tuesday. Powell is set to return to Congress this morning, but this time he'll address the House Financial Services Committee. Yahoo Finance senior reporter Jennifer Schonberger has more on this story. Jen, what are you tracking?
Good morning, Brad. That's exactly right. Fed Chair Jay Powell set to testify for the second day of his semi-annual testimony before Congress, where he indicated Tuesday that the Fed is inching closer to feeling comfortable about interest rate cuts. Chair Powell told Senate lawmakers that he was encouraged by evidence of cooler inflation and that more, quote, good data would help get the Fed to where it wants to be. He also said he viewed the job market as slowing, indicating the central bank is paying attention to a weakening in the job market along with inflation, whereas previously the Fed was more focused on bringing down inflation. Take a listen.
The most recent labor market data do send, to your point, a pretty clear signal that labor market conditions have cooled considerably compared to where they were 2 years ago. This is no longer an overheated economy.
Today, Powell will face a second day of questions, this time before the House Financial Services Committee, where he is expected again to be hit by Republicans on proposed capital requirements known as Basel III, while Democrats are again expected to pressure Powell to lower rates. Powell expected to reiterate much of his same message from yesterday about encouraging inflation data and a cooling in the job market. When asked on Tuesday from Senator Kennedy when the Fed could begin lowering rates, Powell said he was not going to give any signal on the timing of future actions. Investors expecting pricing in a 70% chance of the first rate cut come September. This hearing gets underway at 10 a.m. on Capitol Hill here in Washington. Back to you.
All right, Jen, thanks so much. Well, Wall Street is getting more bullish as the market just keeps pushing higher. The S&P 500 closing at another record high this week. It's 36th record close of the year. And our next guest raised his year-end target for the index for the second time this year. He now sees the S&P reaching 5,900 by the end of the year. Joining us now, we want to bring in John Stolfus. He is Oppenheimer's chief investment strategist. John, it's good to see you again. So here we are this Wednesday morning, raising your year-end target for the S&P. You now have your earnings projection to 255. I'm curious from your perspective, just what you're seeing within the market that tells you that this rally still has legs.
Well, great to be on the show, Shona. Thanks for having me. I've got to say, when we look at the scenario that's unfolding here, you continue to see resilience in the strength of of businesses, of the overall economy. The consumer, even with slowing, is still buying stuff. And services as well, even though the services numbers and the manufacturing numbers have weakened some. This is not unlikely because we've had, 11 hikes and 8 pauses, going from a band of 0 to 0.25 on the Fed funds rate to 5.25 to 5.5. And what it shows is the economy is diverse enough, strong enough, resilient enough to sustain the current rates, to allow the Fed to bring down this sticky inflation. So fundamentally, things look good for revenue and earnings growth going forward. We've already seen that third quarter, fourth quarter, and first quarter S&P 500 earnings going from 2023 to 2024. This has been good. The indication is good. It's not robust, but resilient, and that's what we like to see.
John, indeed. And so with all of this in mind, how many cuts are priced in or baked in to this new target?
Well, we would say 2 cuts, possibly, but we'll even go with no cuts if you're ready for that. We will be Fed dependent. We'll let them be data dependent. We're data dependent as well, of course. But right now, we think they've been reading the tea leaves right when they look at the economic data. We kind of doubt that we'll see a cut in September. We think that the Fed will likely want to continue to reflect its independence in a presidential election year. And with November 7th being the next date of the FOMC meeting after the September date, we'd have to say that there's room to have a little patience here.
And John, in your note, you're saying that we expect the Fed still to be able to avoid a hard landing. I'm curious, though, if they don't cut before the end of the year, what does that landing look like if we eventually are able potentially to get to that soft landing outcome?
Yeah, we think that over the course of it, we could see some increased volatility in the markets between September and November. If we get indication from economic data that the unemployment number is hotter than expected, or that we see other slowing, either in consumer sentiment or services and business PPI. Producer price indexes. That's right. Problems there, but I really doubt it. I think the Fed is set on a likely cut in November, and we think that's a down payment for both Main Street and Wall Street, an indication by the Fed that they are genuinely coming to the end of the Fed funds hike cycle with a message of, but we're not quite there yet, but here's the down payment saying that, yeah, we're getting close to a more normalization standard here.
What is the kind of tenor that you need to hear from CEOs this earnings season to further solidify that we could get to your target?
I think what we'll need to hear, particularly, we think that the second quarter will look good, but we think it's the guidance that we want to really listen to. And what we're looking for is signs that they feel the ability to move through this period of uncertainty, okay, with how slow is the economy going to get while the Fed remains on pause. And that what will support their guidance will likely be the type of products that they offer, where they are in the investment cycle within the company itself, policies of either dividends or, of course, their consumer, whether it's a business or consumers. are they feeling a need to continue to purchase what they offer, whether it's a service or a product?
John, there's been so much talk and really focus on the fact that the concentration that we're seeing play out within the market. I guess I'm curious from you, are you expecting to see wider breadth participation in the coming months? And to what extent are you not too worried about the fact that much of these market gains has just been driven by a handful of names?
You know, the handful of names has really been really from the start of this year. We were still in a process of broadening as the market expected more cuts than have actually materialized from the Fed, okay? And it narrowed, focused on the strength that was being seen within technology, particularly AI-driven names. But we believe that the broadening that we saw from the bottom that the market had last year on October 27th through now shows that we had much broader support for equities across the sectors. And now what we're seeing from the narrowing is the beginning on a day-to-day basis. There's been sort of a churn within the markets where there's a jump a few weeks ago. I think we saw 1 week where value began to outperform growth again. We've seen periods where defensives will pick up against cyclical, and then it reverts back to favoring cyclicals and favoring tech. But if I look at the from the lows in October, I mean, you had really a broad rally across the sectors led by technology, but it did not show that investors were just avoiding other sectors. And we think right now the next step is to buy the AI proxies. You just heard the report that you all were telling us about the PCs beginning to look like a good place to be as business and the consumers ramp up their PC and laptop exposure to be able to take advantage of the AI changes that are coming up. And of course, that involves cell phones as well. So you've got broadening already within tech. But the most important thing to realize is this AI is going to bring about greater efficiencies for both the consumer and business across all 11 sectors. So not just technology gaining from this. This isn't like the bubble period. And I've been in the business for 41 years, so I can remember the tech bubble. This is established technology deeply embedded in the lives of both consumers and business, and a period in which to be able to weather more dramatic times, we're able to do this with aids from technology, which is very simply AI at a lot of levels.
John Stoltzfus, who is the Oppenheimer Chief Investment Strategist. John, always a pleasure to speak with you and get some of your insights here. Thanks. Shifting to a top trending ticker on Yahoo Finance, shares of Taiwan Semiconductor higher this morning after reporting a 40% jump in revenue for the second quarter from the prior year. That rise attributed to growing demand for AI chips here. And ultimately, to kind of give you a kind of year-over-year number that we're looking at here, the year-over-year increase that the company is actually saying a little closer to 32.9% in that year-over-year same period increase. Ultimately, that net revenue number, just to put a number on it, $207 billion, $207.87 billion there. And then you're looking at ultimately a decrease kind of month over month here, slightly from May of about 9.5%. But ultimately, you look at what we've seen in the same 6-month period, January to June, versus the same period last year, also looking at an increase there of about 28% here.
Yeah, exactly. And this all has to do with surging AI demand, right? You mentioned that 40% revenue growth number here in the most recent quarters, the fastest pace that we've seen in just about 2 years since 2022. And why? Well, so many of these companies are willing to spend on AI, trying to ramp up their AI exposure here. And because of that, we have seen a number of analysts over the last week or so talk more and more about pricing power here with TSMC and exactly what that could look like. The potential here to charge customers just a bit more, given that unabating demand that we have seen over the last several quarters. Remember that they're the supplier here for Nvidia and Apple's most advanced chips, so that's really driving much of the interest within this name. But again, you're looking at gains of just about 2% today, and this stock also crossed the $1 trillion market cap earlier this week, just briefly.
Yeah.
So we'll see whether or not we get back there.
Should note that those dollar figures I mentioned were in new Taiwan dollars as well here, just for any viewers out there wondering, and you can run the conversions yourself as well. But this company is also going to be reporting earnings July 18th, so just next
I think
week.
It was just over $6 billion in US dollars.
Yeah.
All right, well, PC demand is rising again, and Apple is seeing the biggest growth. The latest data from global market firm IDC showing that Apple's PC shipments jumped over 20% from the second quarter of 2023, the highest among its competitors. Apple shares have been on the rise so far this year. Shares up just over 20% year to date. And you can see from the chart on your screen that we really started to see shares take off towards the end of April and since then. And it has almost been few hiccups within there, but almost been the steady climb higher. Now here we are just shy of $230 a share. And of course, when you talk about the catalyst here down the road for Apple, lots of talk about investments in AI, what exactly that is going to do to generate interest and demand for the next iPhone cycle that's coming up here in just a few months. And then of course, again, looking ahead to the holiday season, a couple of critical quarters here ahead for the tech giant.
Yeah, 20.8% year over year growth is what they saw. And it was interesting. I mean, even though they were leading, you saw some other significant growth in a company that a lot of people might not be as familiar with or purchase as frequently from, but Acer Group saw about 13.7% year-over-year growth. However, you look across these market shares, I mean, it's still largely led right now by Lenovo and HP Inc., plus Dell Technologies in terms of the second quarter 2024 shipments. Overall market share, though, for second quarter 2024, that's sitting at about 22.7% for Lenovo and then about 21% for HP. So Apple still got some ground to gain there. Larger question of whether or not some of the newly announced features in terms of applications and software developments that rolled out at WWDC and largely kind of focused on that large line share part of the business in the handset, a lot of that question of whether or not it'll translate over to the PC side of the business too and really drive some of this new demand as well for purchases. Hey, we're just getting started here on the Morning Brief. Coming up, a checkup on fast casual dining. We're going to speak to the Cava CEO, Brett Schulman. He's in studio with us next and later. All eyes on Fed Chair Jay Powell. Powell will appear before the House Financial Services Committee as part of his semi-annual policy report to Congress. What this means for the markets later on in the show. Ooh, I hope he's got his energy drink ready for today. All this and much more. You're watching Yahoo Finance. Fast casual dining is becoming a sweet spot for restaurant industry growth rather. Among some of the biggest names in this restaurant sector, you've got Cava, a standout. Shares are on a tear this year, up 110% year to date. Here to weigh in, we've got Brett Schulman, who is the Cava CEO. Brett, great to have you here in studio with us today.
Thanks for having me.
Absolutely. All right, so you're in New York doing some check-ins on some of the local Cava spots here. I mean, what are you finding in terms of the experience? Do you tell them that you're the CEO when you walk in?
No, some of them recognize me. We
Okay.
have some long-term general managers who have been with us who are excited that I get to visit them in person, given the growth we've had operating in 25 states now in the District of Columbia across the country.
Wow.
What are you seeing just in terms of, we've talked a lot most recently about some of the cooling trends that we've noticed outside of Cava within the sector. I'm curious what you have seen trend-wise, whether or not that has shifted at all, given the fact that consumers have remained under a bit of pressure.
Yeah, we talked about this on our last quarterly earnings call, that we've seen consistent strength across all income segments, whether it's at the higher end of the strata or the lower end of the strata. And I think it's a reflection of the value proposition we're able to deliver, that unique Mediterranean cuisine where taste and health unite, and do it at a reasonable price. But also, when you think about value, we think about it in terms not necessarily of price, which is the cost, but a combination of factors. Quality, the quality of our cuisine, the relevance of that cuisine being on trend, Mediterranean diet, #1 ranked diet 7 years running, the convenience in which you access that cuisine, the experience, that hospitality we deliver when you engage with our brand.
So you haven't seen any sort of downturn then?
We have not seen any kind of shift in our consumers, we noted at the end of the last quarter.
You know, one of the things that you also talked about on the call is the timeline for a loyalty rollout, something that a lot of consumers out there lean into when they're trying to get around some of the high prices elsewhere, trying to cash in on some of those rewards. Any more timing, any more clarity around when that loyalty program might roll out en masse?
Yeah, we remain on track. As we talked about at the end of this year, we plan to relaunch the program. We're currently testing it in 2 markets, in our Houston market as well as the Carolinas, and excited to see what the response from our guests and the engagement of our guests. And it's a way to really create our first party audience and to be able to engage in a one-to-one way with our guests for the way they operate through our brand, the way that they behave, and be able to surface relevant content to them. So we're excited to be able to relaunch that and have more value for our guests.
I mean, how many bowls do I need to purchase before I get a free one, Brett?
Well, it's really about points. It's a points-based system, so you earn and bank points, and then you can redeem those points for a variety of rewards in the test market. So it could be anything from those craveable pita chips to eventually a free bowl, depending on how long you want to bank those points.
When it comes to the value aspects, since you brought that up, I think a lot of people have been focused on some of the value launches that have occurred, from most of them being within the fast food chain. But I'm curious, does that at all put any pressure on your business, or have you at all seen maybe more so from your loyal customers this need or this want to have some of those more affordable options?
Yeah, I think we sit at an interesting kind of nexus between traditional fast food below us and legacy full-service chain dining above us, where you can think about a family of 4 going out for dinner, and chain full-service dining experience has gotten expensive, as well as the time commitment, the relevance of the cuisine that I spoke to earlier. Seeing that trade down, they can get a great meal at Cava for a reasonable time commitment, a reasonable value. And then fast food prices have increased, according to the Labor Department, 30%, upwards of 30% from the time period of the end of 2019 to the end of 2023. That's compared to CPI at 18%. And at Cava, during that time period, we raised prices 12%. So that's only kind of amplified or magnified our value proposition, where you can get this great bowl of fresh Mediterranean food for the same price often, or $1 or $2 more than a traditional freezer to fryer fast food meal.
Yeah, I mean, look, it's hard to say that you're going to compete in the value meal wars, especially when you're offering things like steak on the menu and in the bowls here. I mean, and you talked about this in quarters past too, just what that would do to the business, anticipating it would be a margin rate headwind. What's the attribution for kind of the business performance been at least driven by steak right now?
Yeah, we're really excited about our steak launch. We had been testing it for about 7 months, and it has been very well received by our guest base. And it, as we talked about, it would be a COGS headwind from a rate standpoint. But
Why is that?
it's a more expensive protein, but from a penny profit standpoint, it was going to be neutral the way that we had priced it, and then ultimately drive greater frequency, greater top line sales over the long term, as it is another way that we can drive a compelling dinner day part, a dinner occasion. So 46% of our guests come to share a meal with us at dinner. And that's great balance across the country. And so this is another way to address their needs at the dinner occasion.
I was going through a couple of analyst notes before the show, and a number of them talked about the excitement surrounding that new offering. Brett, I also got to ask you about this TikTok phenomenon that's been happening with one of your competitors right now. Many people out there who have been actually going to Chipotle have been upset, accusing them of smaller portion sizes. I'm curious, one, your reaction to that, and two, just how you look at, as the CEO of Cava, just how you look at some of this reaction that we are getting on social media and what exactly that means here ultimately for some of those business decisions that are happening behind the scenes.
Well, I think what you're hearing from customers is, they're pretty fatigued by inflation. We've seen significant inflation in the past few years, and people will pay more, but they want to make sure they're getting good bang for their buck. They're getting good value for what they're paying for. And one of our values at Cava is generosity first and always. So we really work with our teams to make sure when we have this subjective walk the line format and people are picking out what they want to put in their bowl, that they get ample portions. And we work on that every day, and we make sure that if they scoop that spoon and that they don't shake any off, and that they put it in the bowl, and that they make sure people feel that spirit of generosity that is part of our brand essence, part of our Mediterranean way. And we work every day to make sure we're consistent with that across the country.
That's what I'm going to yell next time I'm on the line. Feel the spirit of generosity. My God.
Maybe that'll help you. You never know. Brett Schulman, as always, thanks so much for coming in here. It's great to have you in studio, CEO of Cava.
Thanks for having me.
Let's take a look at some of the auto stocks this morning. Volkswagen shares are falling after the company considering closing its Audi plant in Brussels over weak EV demand. Yahoo Finance, a senior autos reporter, Pras Subramanian, is here with the details. Pras.
Yeah, a lot going on here with this warning from VW talking about how they're lowering their operating return on sales or gross margin about 1% from 6.5 to 7 to 7 and 7.5, or reverse that. But the big issue here is, as you mentioned, that shutdown in the Brussels factory. Now that factory there makes high-end EVs like the Audi e-tron Q8, which is a very expensive EV. And I'm not surprised by that because of the fact that demand is just high. It's harder for an $80,000 to $90,000 EV. But I was just in Europe recently, Germany and Sweden, and cheaper EVs are everywhere. Volkswagen EVs, Volvo EVs, the cheap ones are there. That's what people want, and that's what they're going to shift more towards is the cheaper EVs. It's not an issue of demand from that point of view. It's harder for the higher price stuff. Even in China, even in the U.S., Jim Farley, Ford CEO, says we need to make cheaper EVs and make them affordable. And look what's happening. Their EV sales are up with the Ford the Mustang Mach-E. Also, the Kia and the Hyundai, cheaper EVs, they're also rising too.
Can we talk about Baidu while you're here, Pras? I mean, shares of Baidu right now are moving higher today after options bets, particularly as we've been tracking them, surged to a record. What is the latest here?
So some analyst commentary out here, they're really bullish on their efforts in China with regards to robotaxis. They have an Apollo, that's the name of their vehicle there. It's in dozens of trials in China already. And analysts believe they have the scale and sort of the profitability, efficiency to make this kind of a profitable endeavor for them by next year. And this is happening because we're seeing a lot of even Beijing, other cities in China are opening up regulations to add robotaxi trials. Even Tesla is getting the ability to add that to their arsenal there in China. So a lot of bullishness there on the Chinese robotaxi scene. I also want to mention one quick thing I noticed in Europe. Full self-driving, autonomous driving, not legal yet. You can't even do autopilot there yet. It's very much a regional specific thing. And even the US at this point is more open to that than Europe.
Why would that be?
They're just concerned about the safety issues, is my understanding. So you cannot, like autopilot and even Tesla FSD, not available in China.
Do they have a timeline?
I'm not sure yet, but they're selling cars like Neos that I saw that have sensors everywhere. They can't use them.
Interesting. All right, we're going to continue to track that. We know you will too. Pras, thanks so much. Appreciate it. We're also tracking shares of Carvana moving higher on an upgrade. Analysts at Needham upgrading Carvana, and they're rating to buy from hold, and they slapped a $160 price target on the stock. The analyst behind that call believes that the stock has significant long-term upside. They were taking a look at shares of CVNA this morning. They're up by about 4% here pre-market as they're anticipating this jump of more than 25% and ultimately talking about the unit sales here. They think Carvana can grow unit sales and industry share, leveraging this digital-first customer experience, CX as some people call it, and underutilized physical footprint for the business of car vending machines.
Yeah, I mean, when you take a look at this stock, not a huge surprise that we're seeing some gains here just ahead of the open. You're looking at a gain of nearly 3% there. So again, Carvana is a name to keep on your radar. This price target implies a 27% increase from the close yesterday. As it stands right now, where Wall Street stands on this name, you got 5 buys, you got 14 holds, and you've got 3 sells. Let's kick it over to the opening bell on Wall Street as the bells ring down at the New York Stock Exchange and the Nasdaq here in Midtown.
Yeah, Spectrum 360 ringing the opening bell at the NYSE. And then you've got some funfetti for Talon Energy at the Nasdaq. Did you know yesterday Keegan Bradley was at the Nasdaq? New Ryder Cup captain there.
Okay.
Yeah.
Surprised you didn't make a trip up there.
I almost did. We were on the show. I was between hours at least. So congrats to Keegan Bradley, of course. A lot of people who've been fans of golf or watched the Full Swing documentary. They've seen where he didn't make the cut for the team in the last outing, but now he's going to be a captain. Good on him.
Yeah,
good Boston culture right there.
All right, you've got the S&P and Nasdaq here looking at gains right at the open. The Dow just trading just slightly under the flat line. Jared Blickery standing by with a closer look at some of this movement that we're seeing. Jared.
That's right. I thought we'd start out with the oil market, so I'm going to load the WTI crude futures behind me. And this comes as we're assessing the impact of Hurricane Beryl. Now tropical storm, it has dissipated, and it really was not that much of a factor. Maybe disrupting 70,000 barrels per day of crude oil production. A couple refineries were closed, but really just a drop in the bucket with respect to total supply and demand. So just taking a look at the chart here, here's crude oil overnight. I want to check out the year-to-date chart, and you can see in the run-up to the hurricane, barely even got a bulge there, did not take out the high from April. And so despite everything that's happening nowadays, we have geopolitical concerns, we have hurricane season, which threatens to be worse than usual. We are seeing oil volatility at multi-year lows. And let me just show you, we have the VIX for stocks, and we also have crude oil VIX. Here's the SIBO crude oil volatility index. This is year to date. And if I put a 5-year look, you can see this is in fact the lowest in those 5 years, predates the pandemic. You'd have to go back quite a bit farther. That's 10 years and maybe even farther than that. So suffice to say, there is a lot of complacency in the market. Not a lot of incremental news driving price besides the storm. I believe we got the latest OPEC plus production figures. Looks like Russia is pumping a little bit more than it should be. So is Iraq and Kazakhstan, but not enough to really put a dent on price apparently. So just kind of slugging it out here with WTI hovering above $81 per barrel and Brent just short of $85 a barrel, guys.
All right, Jared, thanks so much. We're going to have much more of your market action next. Keep it right here. You're watching Morning Brief. You're looking at stocks here moving to the upside shortly after the open. You've got the Dow just above the flat line. You've got the Nasdaq leading the way today. Again, this movement coming as Fed Chair Jay Powell testifies for a second day today. It's in front of the House, and that testimony kicking off in just about 25 minutes. Now, we talk about what to expect and what ultimately this means here for the markets. Powell warning about the risks of waiting too long to cut interest rates. Here's what he had to say. All right, well, apologies, we don't have that shot ready for you. But what he ultimately said was he is seeing some improvement on inflation, but he's also worried about not just about inflation, but also some of the weakening that we're starting to see within the labor market. And that's really what the markets latched onto yesterday. So here to talk a little bit more about that, we want to bring in Young Yu Ma. He's BMO Wealth Management's U.S. Chief Investment Officer. Young Yu, great to see you. Apologies here for that shot not playing. But let's talk about what we did hear from Powell and what ultimately this means here for the markets then going forward. I'm curious from your perspective, how much of your day-to-day or really your outlook here for the second half hinges on whether or not the Fed is going to cut rates before the end of the year?
Thanks, Sean. It's great to be here. I wouldn't say that our outlook hinges so much on the Fed as it does inflation. We think the Fed is going to follow the path of inflation, and we think that data has come in favorably the last few months. We think the forward-looking indicators also look favorable for continued softening of inflation. So we're pretty confident that the environment now is healthy for risk-taking and that the Fed will follow and cut rates probably in September, but definitely we think the Fed will begin cutting rates this year because we are seeing some signs of labor market softening, and the Fed is recognizing the two-sided risks, not just to inflation, but also to the labor market. And we think those labor market concerns are probably going to become more front and center if the Fed does not cut rates within the next few months.
You know, it's interesting because as we were listening to the first day of testimony from Fed Chair Powell, when he was talking about the labor market, he mentioned that a broad set of indicators suggest that conditions have returned to about where they stood on the eve of the pandemic, strong but not overheated here. So what type of further deterioration would they need to see in the labor market to feel confident, not just about the first cut, but around a pathway for future cuts as well?
Yeah, that's a great question. It was interesting because our assessment of the labor market is that it's not as strong as it was pre-pandemic. If you look at the sources of job growth that came out of the June jobs report, it was primarily government and healthcare. And then you had downward revisions, pretty significant downward revisions to the prior month's job growth. And that seems to be a trend of downward revision. So we think the momentum is actually a bit on the soft side. So we do think that if the Fed is looking at the totality of the data underneath the hood, not just at the headline numbers, that the Fed's probably seeing the same softness we're seeing. And Chairman Powell is perhaps a little bit optimistic in that assessment of the labor market. It's not quite as strong, we believe, as it was pre-pandemic. So we think just a continuation of these trends, which these trends are for downward revisions to some of the job growth numbers, softening of those numbers, and not seeing broad-based job growth the way that we did see pre-pandemic.
Is the Fed too optimistic about the labor market right now, the jobs market, to the point where it could still have a larger or lingering impact on inflation?
We don't think so. We think inflation is squarely on a downward trajectory, and that will continue. And we think the market, it's possible the market could be disappointed with some of the Fed's messaging in the next month or two if the job market deteriorates or softens a bit more than it has softened, and the Fed doesn't seem to shift as quickly as the market would like it to. But we think ultimately the Fed will shift to getting more into rate cutting mode and recognizing that the risks are probably tilted now to more softness in the labor market, and that given how high interest rates are and how much above sort of the neutral level interest rates are, it really does make sense for the Fed to start the campaign of bringing those down.
So, Young-Yu, what does that then tell us about the leadership that we'll likely see within the market? Is it time for investors to still pile into some of those names that have been working in the first half of the year, or will we see maybe some cooling within that activity?
Well, the names that have been working in the first half of the year will probably continue to be working. There's a reason they worked, and there's just a lot of strength in the earnings momentum in those names. And and the growth in those areas. But we do think that growth is starting to become more broad-based. If we look at some of the earnings revisions that are taking place across sectors, that's more broad-based. We think as interest rates come down, that a broader set of companies will benefit and see some growth in earnings as well, and profit margin growth. So we think overall the picture is a brighter one in terms of broadening of the market relative to what we had in the first half, but it could take a little bit of time, but we do think that's the path we're on here.
Okay, so what type of portfolio pivot or repositioning does all of this trigger as you're thinking about the investment strategy that also comes off of some of these Fed moves?
Well, we do think right now it's still a healthy time for risk taking in the market. We think the earnings season is going to be strong, and what happens when there's a strong earnings season is that companies tend to spend more. And we think it's that business spending that will drive growth in the second half, and the companies are going to be referencing that on their earnings calls coming up, and that's going to spread out throughout the economy. So we think the environment's favorable right now. In the past two election cycles, 2020 and 2016, we have had some softness just ahead of the election in the September and October months. It wouldn't surprise us if that were to happen again this year. But we do think that could potentially be a buying opportunity, and overall that the environment for having a healthy dose of equities here and equity risk still makes sense.
Yeah, FactSet estimating that the year-over-year earnings growth rate for the S&P 500 would be 8.8%, and if it remains there, could mark the highest year-over-year earnings growth rate reported by the index since Q1 2022. We'll see what this earnings season holds. Young Ma, always a pleasure to speak with you and get some of your insights. BMO Wealth Management, U.S. Chief Investment Officer. Thanks so much.
Thank you.
All your markets action straight ahead. Stay tuned. You're watching Morning Brief.
Shares of Chipotle are extending its losses by just a bit. We're off about 0.5% here this morning after the company announced its chief financial officer, Jack Hartung, friend of the show, will retire after nearly 25 years with the company. Now, Hartung will continue in his role through the end of the year, and then he will be replaced by Adam Reimer. He is Chipotle's current vice president of finance. For more on Chipotle's C-suite shakeup, we're going to bring in our very own Brian Sazzi, executive editor here. Brian, so what does this ultimately mean here for Chipotle?
Well, I wrote on the Yahoo Finance live blog this morning, I encourage everybody to check it out, that Jack is one of my favorite CFOs, right along with Jack Hartung and the CFO over at Walmart. And really because it reflects a few things. He's just a good human being. He knows his numbers, strategic operator. He cares about his employees. So for me, he checked a lot of boxes in all the years that I've gotten to know him. And really, I thought we went back to our arsenal of time with Jack, and I really thought this quote on him talking to us in April about the outlook for inflation really rung true and remains relevant to this day. Take a listen.
They will keep the Chipotle in their budget for a longer period of time. We like the underlying trends that we saw in the first quarter. They've continued into April so far. And we're just going to keep motoring. And, our view is if we keep executing at a high level, customers will keep visiting.
And I didn't want to make this sound like an obituary. Jack is very much alive. I exchanged a brief email with him last night. I don't think Jack is done. I'm unsure what his next chapter is. He didn't tell me. Now, Hugh Johnston, he spent mid-decades over at PepsiCo. Now in November of 2023, he is now the CFO of Disney. Do I see Jack maybe in late 2025, early 2026, maybe doing something similar? Perhaps. Bottom line is Jack has made a lot of money. And what people don't realize, he was actually on the board of Chipotle when it was owned by McDonald's. So he has literally grown this chain right along initially with founder Steve Ells from 200 locations. Now he's been, of course, leading it with Brian Niccol, the CEO, to over 3,500 locations. He hands off to his finance team, his new CFO, a playbook to take this chain to about 7,000 locations over the next decade. I mean, Jack has done a heck of a job, has made a lot of money doing it, but above all else, he's just a good human being.
I mean, it's like, what more could you ask for, both from an investor standpoint and if you are Jack and you're looking at all of your accomplishments as the CFO of Chipotle, where as a CFO, you have to give out a lot of no's to people. You almost have to manage up even to the CEO, as Sean and I were talking about at our desks even, to say, here's what we can spend on and here's what is going to be risky for us to spend on, but we'll still greenlight, and here's what's an absolute no. So it's a tough position to be in, but when you're going out to shareholders saying, hey, we get you a 50-for-1 stock split, or hey, we're able to guarantee or deliver these shareholder returns over an extended period of time, like you kind of rest on that laurel and you say, you know what, I'm gonna ride off into the sunset and I can decide where to chart my course from here.
No, it's so on the mark, Brad. Really, I don't think there was anything left for Jack to achieve. You mentioned the stock split. I mean, he's leaving essentially on top. And just lastly, real quick, I think it was our executive producer, Val Cavallo, brought this up, thinking like, why is the stock down when you lose this type of CFO? I mean, you have to keep in mind that Chipotle stock has been up almost like this in a straight line for the past 2 years. So it is a stock very much priced for perfection. You can see that gain in Chipotle. And the street doesn't like change. I think they're used to Jack. They're used to how he communicates stories. They're used to how he does business. He comes out with earnings guidance. They beat it. And not that the incoming CFO is inexperienced, but they haven't been a CFO before. And the street is unsure how they will communicate guidance, how will they deliver earnings, will they raise prices, won't they raise prices? So anytime you see this type of change, sometimes it's not well received. But again, good luck to the incoming CFO. If they were trained by Jack, they will probably do a good job.
Yeah, Adam Reimer, it looked like within the press release, he's been there for 15 years, so a veteran for Chipotle. We'll see what's
a lot of bowls over 15 years.
Yeah, indeed. All right, Saz, thanks so much for taking the time this morning. Guys, Tesla seeing 5 straight days of gains, but an investment firm forecasting trouble ahead for the EV maker. We've got the breakdown on the latest Tesla call. That's right after the break. Tesla shares are flat right now after 5 straight days of gains. But Goldman Sachs not expecting that momentum to continue. The firm forecasting the electric vehicle maker's stock will slide 5% from Tuesday's closing price, but raising its price target to $248. That is up from $175 here. And as we're kind of thinking about the past couple weeks that have been Tesla and news swirling around Tesla really kicked off in force with the deliveries numbers that they put out, and ultimately that coming in better than expected, but a larger question of what levers, and we were discussing this with our own mobility reporter, Prasad Subramanian, earlier in the week, just about what levers this company can pull going forward. They've already, in the previous quarter, talked about vehicles that are yet to come to market where it's expected by some analysts, one that we were speaking with yesterday, and Seth Goldstein, that it is going to be just another iteration of the Model Y, but perhaps a little bit smaller. There are certainly some production efficiencies that Tesla could tout in that regard if it was that type of vehicle, but then price point, where Tesla has initiated and seen this long-standing price war against itself in some instances, but that's also now allowed other automakers to enter into the fray here, especially internationally, where you've had BYD absolutely skyrocket in its own market share in that highly competitive region in China and Asia Pacific more broadly. And so it's going to be key what Tesla has to say about maintaining the market share and continuing to get it back to what investors had come to expect more so globally, and in what margins they're able to communicate they're anticipating for the rest of this year too.
Yeah, exactly. When it comes to this call here from Goldman, their new price target's about a 5.5% decrease from where it closed yesterday. They mentioned the fact, though, that the reduction in inventory levels is a positive sign here for future pricing, but they also went on to talk about some of those headwinds: lower production in the second quarter, the cost of the low financing incentives, and the tariffs here could potentially be a headwind for Tesla down the line. And like you were starting off there, Brad, just talking about the outperformance that we have seen of Tesla stock most recently. This is a stock that has rallied about 44% really since the beginning of June. And you can see that even on the 1-month chart, up more than 50%. So the fact that it has done that, it's added more than $250 billion to its market cap in just the last 10-session rally. That really points to the fact that maybe it is due for a bit of a breather, but I think the question is all surrounding EV demand, what the pricing power looks like, whether or not they are able to offset some of those price cuts that they had to institute over the last couple of quarters to boost demand, and ultimately what that means for their bottom line then looking ahead.
Yeah, the company going to be reporting earnings after the market close on Tuesday, July 23rd, so we'll see what more the company has to say then.
All right, coming up, we've got much more. Fed Chair Jerome Powell is back on Capitol Hill. We will discuss what investors expect to hear about the Fed's path forward next on Catalyst. We'll be right back.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance. Just before 10 a.m. Eastern time here in New York City, I'm Shauna Smith alongside Madison Mills. Let's dive into catalysts moving markets today.
Federal Reserve Chairman Jerome Powell kicking off his second day of congressional testimony in just a minute here. This time he'll be in front of the House of Representatives. Now investors are keenly listening in for more insight on the potential path forward for rate cuts.
All right, and with President Biden now leading the second day of the NATO summit, some Democrats are shifting focus. Instead of just defending Biden, they are now shifting that and pushing back against former President Trump. We'll discuss how Biden's NATO performance could impact his campaign.
And we've got Microsoft and Apple taking themselves out of the running for OpenAI board seats. This comes as regulatory scrutiny is heating up both in Europe and domestically. So we're going to dive into what this could signal moving forward for the tech sector. But first, coming up here, Fed Chair Jerome Powell is speaking right now before the House Banking Committee. We'll be looking for headlines here as they come in, but we know yesterday some of the key drivers of his commentary and therefore the market movements were some of his comments about inflation cooling, sounding potentially a little bit more dovish for the market moving forward. Let's take a listen to what he had to say.
If we loosen policy too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation.
But how much emphasis should markets be putting on the Fed's path forward? Joining us now to discuss this, we've got John Petrides, a portfolio manager from Tocqueville Asset Management. We've also got Kevin Flanagan, head of fixed income strategy at Wisdom Tree. Thank you both for joining us and thank you for being in studio. We appreciate it. I do want to start with you because you just heard that soundbite from Fed Chair Jerome Powell. Did any of his commentary move the needle for you at all? Was it more of the same?
Well, I think the Fed has been very cautious of not wanting to repeat 1970s Fed policy mistakes of stop and go, right? So clearly there's more conviction, and I think a lead up to the Jackson Hole meeting in August, where the Fed will probably start talking about cutting 25 basis points or something along those lines. So that's a really good sign, I think, from that perspective. And those that are still convinced the Fed is going to raise rates, that's off the table for at least the next year.
And Kevin, when it comes to what has really been moving the bond market, obviously lots of focus here on inflation and exactly what we have heard Jerome Powell say and kind of the change in tune almost just in terms of also a little bit of worry about what's been going on within the labor market. But Kevin, I'm curious from your perspective, what's been the biggest driver of yields when it comes to Fed and commentary and really what investors should be focused on?
Well, I think your point is very well taken that they're back to the dual mandate. The whole focus had been inflation, inflation, inflation. And I think Powell pretty much laid it out yesterday that the risks are now balanced and that he is seeing some cooling in activity in the labor markets. I mean, jobless claims are still, though, 100,000 below where they normally are before a recession, even the pre-COVID 40-year average. So it's not as if it's weak or falling off the cliff. And I think that's what Powell's trying to do, is to strike a balance here with respect to policy going forward. To the point, once again, being well taken, the Fed does not want to make a mistake here, one way or the other, right? They don't want to be on hold too long, but they don't want to cut rates too soon. So it is kind of a tightrope that Powell and company are walking. And that's what the bond market's trying to figure out and why we're going to continue to see volatility. A highly data-dependent Fed, highly data-dependent bond market, that equals volatility.
Kevin, do you think we're going to push back up against that 4 or 5 level in the 10-year?
Yeah, you know, I would say 4.5 is kind of an equilibrium level, plus or minus, say, 20, 30 basis points. So 420 to 470. Some people might say, hey, you can drive a truck through that. But back to my point before, that's where we're at this stage of the game. So I think if the numbers continue to come in as they have, you open the door for a September rate cut. But remember, this isn't going to be like the rate hike cycle. This isn't going to be, you know, every meeting. It's going to be a little bit more choppy, 25 here, 25 there.
John, I know that you say on Fed rate cuts, who cares? Which, of course, what else would we talk about if we didn't get to digest this and dissect it every single day? But I'm curious if you think that the Fed cares about what the market is doing, given some of the frothiness that we're seeing and the kind of idea that there's this unofficial third mandate for them to make sure that there's not a market crash.
The Fed will definitely say they don't care what the market thinks. And I think the fact that volatility has been so quiet, like strangely quiet, the VIX is really, really low, that the Fed is not overly concerned, that they're comfortable with where their language is. If we saw volatility pick up and the VIX get higher and you see more of a sell-off in the stock market, I think the Fed would be definitely more market friendly in terms of its language.
So, John, how should investors be thinking about positioning then, just given so much of that uncertainty?
Yeah. You know, we've owned a position in gold for the clients that we manage for a very long time. We increased it in January of 2023, and we still maintain a high level position of gold for our clients. We think there's way too much uncertainty with the amount of debt the U.S. has on the balance sheet. Gold typically does well when interest rates come down. So if the Fed is in the process of starting to ease, that will benefit gold. And again, we think the fiscal and the deficit and the debt situation in the U.S. is way too uncertain. Let's not forget that geopolitical and political risk globally is a big issue. That again, with the VIX being so quiet, for me, it's a red flag that the market seems overly myopic on just what the Fed is doing.
Well, it's interesting, too, given what we're seeing not only with equities, but also in terms of yields. So, Kevin, I want to go to you on that, particularly in relation to what we're seeing heading into the election come November 5th. We saw that yields fell off the back of the debate. Do you anticipate politics continuing to drive what we're seeing in the yield space?
No, not really. I do think, from time to time, you could see it on a daily basis in terms of trading activity. I think overall it's the Fed. That's the name of the game here, as you were just talking about before. And what is this rate cut cycle going to look like? We're trying to figure that out. And I think when we're looking at the shape of the yield curve, I think that's important as well. It's still inverted. It could uninvert maybe sometime next year per se. And that's why we've been talking about barbelling strategy within the fixed income arena, trying to take advantage of that inverted curve, but also having something a little bit moving out, maybe closer to core duration, in case things do get a little bit sloppy on the economic side.
John, when it comes to some of that risk-taking that we have seen, we certainly do see this appetite for risk play out in the market, and I think that is something that seems to be a theme here as of late. Could that lead to, I guess, are we starting to see excessive risk-taking, and what exactly does that then signal for?
Yeah, I mean, I think it's going to be important to see when the banks report earnings where risk is being taken. It's going to be interesting to see this upcoming earnings season if the consumer and industrials start rolling over. But that's the problem, though, when volatility is quiet. Right, you've had a rally, a very strong stock market since Halloween, basically of 2023. The S&P has only been down 1 month for this entire year. People get very complacent and comfortable, and it leads them to take on more risk. You see leverage ratios going up. We had the GameStop meme craze get back in the headlines again. So spreads, I don't want to step on Kevin's toes from the fixed income side, but spreads are really tight from a high yield standpoint to treasuries, which means investors are taking on more credit risk to pick up just a little bit more in income. And those are some signs that, maybe risk tolerances are getting stretched a little bit too far to pick up some return. Those are things that my antennas are up for sure.
Is the new way to position conservatively just going all in even more on large caps?
No, not necessarily large cap. I think there's value to be had. International stocks are trading, developed country international is trading at a big discount to the U.S. Look, it's no surprise. The U.S. large cap tech is the most crowded trade maybe in the history of my career. Everybody knows the whole world for the past 7 years has been in U.S. large cap tech growth, right? And everything else, value, international, small cap, is traded at a huge discount. So I think there's value to be had in other parts of the market to compensate for a position that basically everybody owns. And if you don't own it individually, you probably own it somewhere in a mutual fund or an ETF, somewhere within your portfolio. So there's diversification to be had in other parts of the market for sure.
All right, John Petrides and Kevin Flanagan, thanks to you both for joining us here today.
Thank you.
All right, turning now to some big tech news. Microsoft deciding to step back from the board observer seat at OpenAI after the role drew regulatory scrutiny. This comes after Apple also took itself out of the running for the role. This is all according to reports here from the FT. Are big tech companies feeling the pressure from regulators in the U.S. and the EU? And that was the question that had been posed and something we had been talking about a little bit earlier here, Maddie. And I think my answer to that is clearly it has generated some interest from regulators. We talk about the outsized impact or some of that worry that has been circulating over the last several weeks about the outsized impact that some of these larger tech companies have had on AI. When we talk about all the AI excitement, what exactly that has generated here here from Wall Street, from investors, from companies of the like. And there has been some worry over the influence of that. So you would think this move here from Apple, from Microsoft, here relinquishing those observer board seats will make possibly some of that scrutiny go away, but I think only time's really going to tell on that matter.
Well, it's really smart of you to focus on the regulatory piece, because from the company perspective, we're hearing them say things like, we just no longer believe our limited role as an observer is necessary. This follows, of course, Microsoft's $13 billion investment in OpenAI. Then last November, when Sam Altman was ousted from the board, the kind of resolution after Satya Nadella kind of reinstated Sam on the board was to give Microsoft a board seat. Now the company saying, okay, we feel comfortable leaving them alone for a little bit. They don't need the parent in the room anymore. But I think to your point, Shauna, that's a very convenient opportunity for them to take off the pedal from the gas a little bit there and have the opportunity to take a step back, given the regulatory pressure that we've seen in Europe, obviously the UK, and then, of course, here in the US. But then I have a broader question about whether or not the board is ready to have the parent step out of the room and what that might mean for OpenAI's future as we see continued questions about Sam Altman moving really quickly on AI.
Yeah, exactly. And I think that is the question, exactly what the future looks like for OpenAI if they don't have those observable role on their board here from Apple and from Microsoft. But again, from a regulatory perspective, just given what the chatter has been, it seems like that would have had some influence here within those decisions. But who knows? Maybe we'll get some clarity.
Right, exactly. All right, well, we're turning now to President Biden. All eyes are on him as he leads the NATO summit in Washington. Democrats are divided, though, about what the president should do next. Former House Speaker Nancy Pelosi this morning saying, quote, it's up to the president to decide if he is going to run. We are all encouraging him to make that decision because time is running short. Notice she did not say which way on that decision. So joining us now with the latest on the campaign, we've got our very own Rick Newman. Rick, thank you so much for joining us here. Obviously, this is a really important week with NATO members in Washington. To what extent is some of the commentary around Biden's campaign like that from former Speaker Pelosi kind of clouding the ability of these NATO leaders to be able to get anything done here?
It is certainly clouding what's going on with the NATO meeting. The NATO meeting is really important, mainly because of Russia's war in Ukraine and the need for NATO to demonstrate that it has the credibility and the power to stand up to Russian military advances in Eastern Europe. Biden, he has been the leader of that effort, and he yesterday he got credit for making a forceful speech, pushing back on Russia and saying there's no chance they will win. And commentators pointed out that, wow, he got through a whole speech without fumbling any words. I mean, that's not the way you want your speech to land when you're talking about stuff like this. So, Biden, in a way, he kind of seems like a lame duck president almost, which would be a president who is on his way out and is, in the last couple of months of his presidency. Now, Biden, of course, says, no, that's not the case at all. So listen to the tone of what Nancy Pelosi said there. What everybody has been watching for has been what a few of the key sort of kingmaker Democrats are going to say about Biden's predicament. And Nancy Pelosi is one of those crucial Democrats, and she is now kind of saying maybe Biden should think about stepping back. I mean, she said Biden needs to decide. Biden would say, I've already decided. I'm in this race. That's what he keeps telling everybody. And Nancy Pelosi now today says, well, he needs to think this through and tell us what he decides, as if, well, maybe he hasn't really made up his mind. I mean, the Democrats have a couple of weeks to get this straightened out. But by the time we get into late August, when their convention is, and for sure September, when the election is going to be in the final stretches, Democrats need to have a candidate. They are all behind and put all this drama about whether Biden should be in or not behind them. We'll see if that happens.
All right, and Rick, well, we've been asking guests all week about the possibility of President Biden stepping aside in the race. Our executive editor, Brian Sozzi, spoke with Bradley Tusk, he's Tusk Ventures founder and CEO, and asked him about the possibility of President Biden withdrawing from the presidential race. I wanted to play this clip and then get your reaction on the other side.
I would tell him to step down, or he doesn't have to withdraw. Actually, the best thing he could do if he said to me, it's really important that if it's not me, it be Harris, then you should actually resign and let her be president and have that peak and purview. Assuming he doesn't really care about that, the next best thing would be for him to withdraw from the race. He can endorse her, or he can say we're going to have an open convention. Either way, he doesn't have the power to pick the successor either way. And like, to me, the one caveat or carrot you could offer him is like, look, now you can pardon Hunter. So if you're, because the odds of him now winning this election feel very, very low.
Rick, I'm curious just on your thoughts there of what we just heard from Tusk, and then also just the talk here that Vice President Harris would likely be the Democratic nominee if President Biden were to step aside.
Well, I mean, everybody has an opinion on this, and it's not just should Biden stay in the race or should he not stay in the race. There are many permutations here. Should Biden resign as president? I think the answer to that is no, he shouldn't. But should he resign as a candidate? A lot of people think he should. And if he does resign, then what happens? Does he sort of anoint Kamala Harris the vice president, or does he endorse anybody, or how do they actually figure out who the candidate is? There's a lot going on here. I mean, Brad Tusk has insights. His insights are interesting because he helped run Mike Bloomberg's campaigns when Mike Bloomberg was a Republican and then an independent mayor of New York City. And he also worked in the Senate on the Democratic side. So he has insights into this. But there's just a whole range of possibilities. And what we've been seeing since that horrible debate by Biden on June 27 is the Democrats are not coalescing on any one of these options. So, the story 2 days ago or 1 day ago was that Biden seemed to be kind of bouncing back. He has beaten back a lot of these calls for him to drop out. And then people like AOC, the squad member in the House, she said, I'm with Biden. So it seemed like he was getting a little more support. But now, as we just discussed, Nancy Pelosi comes on TV and says, well, maybe basically says, I'm paraphrasing, maybe he needs to think about dropping out. So there's just no consensus forming among Democrats, and people giving their opinion is not leading anywhere. It's just leading to like a squall of multifarious opinions blowing in every direction.
All right, Rick, always great to get your insight. Thanks so much for hopping on with us again.
Bye, guys.
And don't miss a full episode of the Opening Bid podcast with Bradley Tusk, Tusk Ventures founder and CEO. That's out this Friday, 8 a.m. Eastern, right here on Yahoo Finance. We'll keep it right here. We've got much more of your market action ahead. Again, you're still looking at just about a mixed picture. You got the Dow now trading below the flat line. You've got the S&P and Nasdaq holding on to gains. Much more ahead. You're watching Catalysts.
get to some trending tickers that we're watching this morning. Shares of Nvidia. No surprise here. Moving to the upside again this morning, and Wall Street remaining bullish. Just yesterday, KeyBank analyst John Vinn raised his price target on the stock to 180 from 130, implying a 37% upside. And we've got more bullish commentary on Yahoo Finance's brand new show, Opening Bid, this morning. EMJ Capital founder Eric Jackson telling our executive editor Brian Sozzi that there's a world where Nvidia could hit a $6 trillion market cap this year. Take a listen.
I could see this thing hitting up, between 200 and 250 per share by the end of this year. And so the reason is that in the last 5 years, if you go back and look at what, how the forward price earnings multiple has varied for Nvidia over that 5-year period. My belief is that, we're now kind of going up again with Nvidia.
And this is interesting given what we've seen over the past couple of months here, really, with Nvidia stock, of course, on a tear. But then we had a couple executives, including CEO Jensen Huang, selling off their own stake in the stock. That led to a couple of days, and was one potential reason that led to a couple of days of declines on the name, along with some macro concerns and then potentially just a bit of profit taking. But no surprise to see the stock up today, particularly after the amazing results that we got in, Shauna, from TSMC, seeing those June sales coming in at nearly $208 billion versus the estimate that was around $156. So a huge beat there, and that is going to be a bullish signal for Nvidia, as TSMC is kind of the manufacturer of their chips.
Yeah, what's also interesting has just been how much attention this has obviously garnered on an institutional level, nothing new, but also just amongst retail traders and amongst day traders. You talk about some of that interest within the stock and some of the data that BI has crunched here over the last couple of days, saying that Nvidia-focused ETFs have taken in $4.4 billion so far this year. That's roughly 6 times more than what they took in during all of 2023. And meanwhile, when you compare it to Tesla's amounts as to just over $1 billion this year compared to $2.8 billion the previous year. So $1 billion in Tesla this year comparing to $4.4 billion in Nvidia. And I bring that up just because I think that speaks to the excitement surrounding the stock, this moat that they have created, at least for now, in terms of AI demand. They really have been the face of this rally, clearly the biggest driver of the gains that we had seen year to date. So whether or not that momentum holds, of course, that is going to be the question, as it has been the last several quarters going into this earnings season, and what we are going to see from Nvidia and some of the other market leaders as to whether or not maybe that indicates whether or not this rally is going to be able to be sustained to some point to the upside or not, or if we could see some broader pressure on shares, but we'll see.
Yeah, absolutely. A lot to come in that earnings cycle coming up here. We're also looking at shares of Spotify taking slightly lower, down about 1% after getting a downgrade from Redburn Atlantic to a sell rating. The analyst saying Wall Street is, quote, simply forecasting too much growth for Spotify. This is actually a bit of a recovery for the stock. They were down a little closer to 1.8% in pre-market trading here. Interesting, though, it's up over 60% year to date, over 65% actually year to date. But the argument here is just about valuations, and we're consistently seeing the valuation critique coming up in analyst notes here, saying that the expectations for growth are simply too high. The analyst going on to say that music streaming is facing a lot of competition and structural challenges that they argue is going to prevent them from price increases that they are anticipating to come. And that is interesting, given also the price increases that we've heard teased out from some competitors in the streaming space. The extent to which Spotify is going to be able to be successful in their own price increase efforts remains to be seen, of course, Shauna.
Yeah, the team there saying that Spotify's operating momentum has been impressive. Consensus is simply forecasting too much growth, talking about some of those lofty expectations here. So their new price target implies about a 26% decrease from where it had been trading. So again, just some important things to keep in mind. They also just talked about more stiffer competition within the space. That has been a narrative that has been surrounding Spotify for some time, just how much pressure that could ultimately put on the company here going forward, especially when you compare it to some of the larger names within this space, when you talk about Apple Music or some of the other offerings from some of the larger tech giants, and also just some of those structural challenges when it comes to that broad-based price increases becoming a new norm, just how much pricing power they have there and how much people are essentially willing to pay for their Spotify subscriptions. And I know I was just looking at mine, and it's getting more expensive. And it's something that people are noticing, and people might be making adjustments. When you talk about churn to any sort of service that you're paying a monthly fee for, you got to think that within this time when consumers are under a tremendous amount of pressure, that should be and probably is, and very much is actually when you go into some of these recent analyst notes, a concern here for names like Spotify that obviously rely extremely heavily on consumer spend and the health of the consumer. Absolutely. All right, let's talk about shares. Speaking of the consumer, let's talk about shares of MasterCard falling after Bank of America downgraded its rating on the stock from buy to neutral. They lowered their price target for the firm from 505 to 480. Now the stock right now is off just about 2.5%. They also revised their outlook for Visa as well. That's falling just about 1.5%. But for MasterCard, it's the biggest slump that we've seen in just about 20 weeks. Bank of America also downgrading Visa to neutral. That stock off, like I said, just around 1.5%. Both calls are related to valuations, crowded investor positioning. It very much goes back to this theme that we have been seeing surrounding specific names, calling into question their current valuation and whether or not they might be positioned now to take a brief, rest or on the sidelines here, at least when it comes to those current valuations, and whether or not some of those fundamentals support where they are currently trading.
Yeah, it was interesting that the call here from B of A was very much tied together for Visa and for MasterCard. Now, they say that the premier businesses for both still look like they have some upside to come, particularly given the, quote, competitive moat surrounding these companies, and that this is a non-consensus call on the downgrade. But also interesting for those who are looking at these names heading into this earnings cycle. They do note that this is not a call on this quarter specifically. They see calendar Q2 estimates as achievable amid the broader consumer spending environment. They say that's going to be enough to give them some acceleration heading into this quarter, but they're going to have some second half of year challenges that could materialize more long-term, less than the near-term challenge that they could be facing given that consumer environment that we are seeing here. Well, coming up, that earnings cycle just around the corner. We're going to dive into the expectations for big tech. That's coming up next on Catalysts.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
The S&P 500 just notching its 36th record close of the year on Tuesday, and it's moving higher still today. The hype around AI has been a big driver of the rally, and according to a BlackRock report, we should not expect this to change too much anytime soon. Joining us now on this is our very own Inez Ferre. Inez.
Yeah, Madison, and BlackRock strategists are comparing the transformation related to AI, the energy transition, and the rewiring of supply chains to the Industrial Revolution. That's because of the massive amounts of capital spending that is happening in this space, with estimates of AI data center investments, for example, growing by 60 to 100% annually in the coming years. Now, what does this mean for investing? Well, strategists see the AI theme continuing to drive returns, with some broadening out into other sectors besides tech. And while investors may be tempted to stay on the sidelines for now with $6.15 trillion in money market funds, these strategists are saying the best returns will come by stepping out of cash and leaning into risk. You have to be very selective. Fundamentals matter, and you have to find the pockets of strength. One of the things that investors want to see is a broadening out of the markets. Nvidia and big tech have done a lot of the heavy lifting. Now, these strategists are saying that the broadening is happening in AI and AI beneficiaries. So, for example, energy, utilities, industrial, healthcare. These are some of the sectors that are set to benefit from AI, either through the build out or through the adoption of AI. And you can see, for example, utilities, we've talked a lot about, you guys. Year to date, utilities ETF is up more than 8%. Last year, it was down 7%. A lot of this has to do with powering the AI data centers, the electrification of the US, and it's not just data centers, it's also chip factories, reshoring of supply chains here to the US. So by broadening out, they're meaning that this is broadening into other sectors that are going to benefit from that AI adoption and build out.
All right, Inez, thanks so much for breaking that down. Well, speaking of tech, tech is in the spotlight as investors do question whether or not the market's recent standouts are going to continue to lead the way higher in the second half of the year. Our next guest still sees upside ahead for this sector and expects AI to catalyze the broader tech rally. Joining us now to talk a little bit more about this, we want to bring in Scott Devitt. He's Wedbush Securities Managing Director of Equity Research. Scott, it's good to see you. So I think a lot of people are questioning what exactly that upside looks like here for tech and these quote unquote market darlings here of the last several months. What do you see the second half of the year shaping up like?
Well, good morning. And, it's been an interesting ride post-pandemic. 2022 was a very difficult year for these companies, and they're all getting back to their normal states now in terms of run rate revenue growth with operating margin expansion and, generally speaking, more disciplined management teams because of 2022. And so while the performance of these larger internet and broader technology companies has been strong, the past year and a half, the multiples are not extremely high, relative to history and relative to other industries. So we still very much like consumer internet and specifically Amazon, Alphabet, and Meta in terms of the mega caps. And we think the underlying trends and fundamentals of the businesses are as strong as they've ever been.
Yeah, it'll be interesting to see what we get from this quarterly earnings cycle in terms of data around how much the investment on Gen AI from those companies is going to actually lead to any tangible revenue that we can see. Can you talk about what you are expecting in terms of who might be the winners and losers based on the amount of CapEx they've put into AI and who will be able to prove out that investment this quarter?
Well, it's early days. Nvidia can clearly prove it out. They're selling the chips to all the hyperscalers right now. The companies, that I follow, certainly Amazon and Alphabet, given that they have data center businesses that are selling into the corporations, that are going to be actually utilizing AI, you're going to start to see benefits there. Microsoft's already seen it. Alphabet and Amazon have been a little bit further behind, but I think you could see some quantification of revenue contribution from AI from those two businesses. As you mentioned, both companies and Meta are spending aggressively on AI, data center-wise, in terms of serving customers for Alphabet and Amazon. Mm-hmm. And for Meta, it's in terms of the spend to try to generate revenue over time in their consumer-facing businesses. So that's the one caveat here, that cost in the short term don't get out of control as we await the revenue contributions. And I'd say that's probably risk number one in the back half. But I do think, the market is very excited about AI, and to the extent that the underlying businesses remain fundamentally strong otherwise, that they're going to get a pass for the time being. That may change in 2025, but for the next 6 to 9 months, I think these companies still have a pass.
Scott, I'm curious what you make just about the argument of some of those rich valuations of big tech, of AI. Yes, earnings growth has been supportive, but the bar has been set very high this earnings season, and especially looking ahead. Is that at all a concern just from a valuation perspective?
Well, they're high relative to history. They're not very high. Like Meta's a mid-20 times forward gap earnings multiple company, and Alphabet's slightly lower than that. Amazon's 33 times. And I love Costco, but Costco trades at something like 45 times. And Amazon's a quite different, more dynamic company in the end than Costco. And so, you have to take a step back. It's always easy to sell winners after good periods of performance. And we've definitely, probably overanalyzed this in terms of making sure that we're comfortable sticking around. But, what I think here is that the fundamentals are strong. The underpinnings of AI, while still in question in terms of revenue contribution, are not going to be necessary, for still a little bit of time. And these valuations, whereas they're elevated relative to history, they're not really expensive relative to other industries. And I'm speaking specifically to my coverage area, which incorporates Amazon, Alphabet, and Meta. But when I look at other industries, they're just not high multiples.
I do want to talk briefly about regulation, and this is top of mind for us today as we've been talking about Microsoft and Apple stepping back from their board seats with OpenAI, given some of the regulatory pressures that we've seen in Europe and domestically here in the US. To what extent is regulatory pressure a headwind that you are thinking about in the names that you cover, and which of the names that you cover do you think is the most at risk for regulatory pressures?
Regulatory, is something that's been around for with these companies for a decade or more, and I think it's been more problematic to pay too much attention to it than it has been to just simply ignore it. It doesn't mean that that's the right answer from here, going forward. The last company that it probably made sense to pay attention to was Microsoft, many years ago, and I don't anticipate that there's going to be anything done to any of the companies that I'm responsible for, or more broadly in the tech industry, that is a repeat of what happened to Microsoft in the beginning of the internet cycle. And so we pay attention to it and we monitor it from a headline standpoint. But I do think that it's very manageable, no matter whether you're looking at the FTC attacking Amazon or looking at OpenAI and generative AI, as a category, and there being more regulation there, because frankly, there are some guardrails, that are needed. And I do think that from an investment standpoint, investors would be better off looking at the fundamentals of the business and less so being overly concerned that regulation is really going to slow down this cycle.
Scott, I'm curious, and I don't know if it really falls within your coverage, but as you're assessing this AI revolution, who are the losers within this space? When we talk about there's so much excitement surrounding who is leading it, who is at risk, do you think, of really just falling behind given the rapid developments that we've seen?
Well, so you've got semiconductors and then the cloud businesses and then the consumer-facing companies. In semiconductors, it's anyone that's that's in the crosshairs of Nvidia at the moment. And so I think that a rising tide is lifting all boats as time goes on and the excitement passes and companies have to provide real results. And I think laggard businesses in that area will be presented in maybe a similar list to what's already been in the recent past, companies like Intel and things like that. As it relates to the hyperscalers and the software industry, I think it's TBD. Microsoft has a nice early lead in cloud. The software businesses, it's anybody's guess how AI is going to ultimately affect them. And so I think there's a lot of work to still be done there in terms of understanding winners and losers, but I'm comfortable thinking that Microsoft Amazon and Alphabet are all, net winners in that regard. And then finally, on the consumer side, this is like internet before broadband. So talk to me in 3-4 years. I have no idea. I would make bets on the companies that have proven competency through prior cycles that they're going to figure out AI as well, but it's early days.
Well, Scott, that brings me to my last question. Last night, I was at a dinner with some Amazon executives who were saying that they see AI being bigger than their cloud business moving forward here. Do you agree with that?
Over the next decade, yes. I think there may be a hiccup, just like there have been in prior cycles, most notably, that transition from dial-up to broadband, or whatever you want to call the various factors post-internet bubble. But in the long run, it's going to be a massive wealth creator. You just have to be careful, shorter term, that you're not too overweight at the wrong times.
All right, Scott, we're going to have to leave it there. Really appreciate you joining us. Thanks so much. That was Scott
Thanks so
Devitt.
much. Yeah, thank you.
He is Wedbush Securities Managing Director of Equity Research. Thanks. Coming up here, Fed Chair Powell is testifying before Congress this morning for the second day. We're going to give you more hints and insights about what he says about potential future rate cuts. That's coming up next.
Fed Chair Jay Powell testifying on Capitol Hill today, this time before the House Financial Services Committee as part of his semi-annual congressional update on monetary policy. Here with more, and she's been monitoring the testimony so far this morning, is Yahoo Finance's very own Jennifer Schomburger. Hey, Jen, what are we learning?
Good morning, Shauna. The question and answer session just getting underway as Chair Powell testifies for the second day of his semi-annual testimony before Congress. Powell signaled again that the Fed is inching closer to feeling comfortable about interest rate cuts. He reiterated to the House Financial Services Committee that he's encouraged by evidence of cooler inflation and that, quote, more good data would help the Fed get to where it wants to be. Republicans already hitting Powell very hard on reproposing capital requirements known as Basel III. House Financial Services Committee Chair Patrick McHenry told Powell that the Fed needs to make a new proposal for Basel III and that failure to do so would result in an immediate Congressional Review Act vote on the House floor. Now, Powell was also asked about where the Fed is in the process of shrinking the balance sheet. Powell said the Fed still has a ways to go in that process. He also reiterated that he believes the path for debt is unsustainable, but that the current level for debt is not. Monitoring this hearing for anything Powell says on monetary policy, and we'll bring that to you when I get it. Guys?
All right, Jennifer, thank you so much as always. We really appreciate your insights there. Now, it's been a big headline year for M&A activity, including Capital One acquiring Discovery, large energy acquisitions involving ExxonMobil and ConocoPhillips, and of course, that ever-evolving and seemingly never-ending Paramount saga. So what should we expect M&A to look like coming into the second half of 2024? Joining us now to discuss, we've got Mark Cooper, Solomon Partners CEO. Mark, thanks for being here. It's always great to speak with you. I want to start on just what you're seeing. Your team sent over some data on the increased value overall of the deals that you're seeing, but that the number of deals has decreased. What do you think is driving that bifurcation?
Private equity. Well, pleasure to be here, and thank you for having me. But it's all about private equity. A little bit of the tale of two cities. Strategic M&A is doing great. I think it's up 35% year over year, and a lot of noteworthy transactions. In fact, you probably saw we just announced advising Saks on the acquisition of Neiman Marcus. So a lot of noteworthy transactions, a lot of optimism in the boardroom, a lot of reasons to be employing M&A as a tool for growth and for value creation. The real issue is private equity, and private equity has yet to come to that equilibrium point where buyers and sellers' expectations meet. And it's a particularly long time since the run-up in interest rates that it's not gotten to that equilibrium point. That's unusual. But then again, we've been through some pretty unusual times over the past 3 years, given the pandemic, given the excess capital in the marketplace, given zero interest rates, and then a 500 basis points or 525 basis point increase in interest rates. And it's just taking time to work through the system.
Mark, I'm just curious your thoughts. Is private equity in a bubble right now that's about to pop, given what you just said?
Well, I always think about bubble as people who've overinvested in assets, and now they're going to be it's going to pop. But in this case, it's more of a cork coming out of a bottle, if you will. So there are an unprecedented number of assets owned by private equity that are slated for sale, but are not getting done because of price discrepancy. It's really going to be an issue just of accepting what the new price reality is. What will that mean to private equity? Well, it means the vintage of those funds will probably be not as good as prior vintages, which has happened before. I don't think it's about distress. I don't think it's about them having to go through recapitalizations and transactions that will wipe out their equity. It just means lower returns. But once, in fact, they get through that divestiture sequence, it'll just open up their ability to deploy the excess capital they do have, which is still an unprecedented amount. I heard on the order of $1.2 trillion that's out there to invest, which they can't do until they clean out the system, if you will.
Mark, I guess my question is, in terms of what's going to be the next catalyst here for M&A, we talk about the need of participation here from the PE side, but what needs to happen in order for that activity to pick up, and how much of that ultimately really hinges on the Fed cutting versus something else that's going to be the driver here in the longer term?
There's nothing about the market that prevents people from doing transactions. As you're seeing, there's plenty of debt in the market. And again, back to the Saks transaction, we raised $2 billion in debt financing. And there were plenty of opportunities and different actors who we could have worked with. So it's not like there aren't the tools out there to get deals done. It's a matter of price. What could be the instigators to taking or to removing that cork from the bottle? Yeah, it could be an interest rate cut. And would that make a huge difference? Yeah, well, maybe it will harden the view of sellers to say, well, if interest rates are down, I still want my price. So you could look at that as positive or negative. But it could unlock some of the jam between the difference in a compromise fashion. The other thing just is time, because there is a different strategy which people are employing, which is to say, yeah, we wanted to sell last year, and that would have been a better return on my investment. But if I wait another year and I earn more on the business that I'm selling, my dollar that I would receive, the amount I would receive would be the same, albeit at a lower multiple, which won't be great for rate of returns, but it will be great for return of capital in terms of what we refer to as MOIC, or money on top of money invested.
Really quickly, Mark, I'm wondering what you're seeing in terms of valuations. Are you seeing people coming in and expecting to get the record-breaking valuations that we're seeing in the broader market with some of the big tech names?
Well, it's so fascinating because, keep in mind, the private equity is on both sides of the equation. On the one hand, they're buyers, and they say, well, that asset's not worth that. And then at the same time, they're a seller, and they say, well, my asset's worth that. So it's an interesting quandary. There are still the best of the best, as always is the case, are getting some nice values, but it's not yet rebounded. 21 was a high water mark. It then came down, but it's not to where it has been historically. It is not at multiples where it needs to be to clean out the system.
All right, Mark Cooper, Solomon Partners CEO. Thanks so much for having on with us here this morning. Great to talk to you.
Thank you.
Keep it right here on Yahoo Finance. We got much more of your market action ahead. Stay tuned. You're watching Catalyst. Let's talk about earnings season. It officially kicks off tomorrow. We've got Delta, PepsiCo, Conagra Brands all set to report tomorrow. And then we've got a huge day on Friday with the big banks. Analysts now are expecting growth to start to broaden beyond tech. And that really is a question here, Maddie, of what so many investor strategists have been talking about here on our air over the last several weeks and several quarters is just when we have this market dominated by a handful of tech names, clearly they have really been driving the earnings growth picture. And I want to pull up this chart that we have right now here from Wells Fargo. And this was one of their charts of the days most recently here. I believe it was last week. And they were talking about the performance of Magnificent Seven when it comes to earnings growth versus those within the S&P minus the Mag 7. And you can see the Mag 7 names are the dark purple versus the rest of the S&P, which is that lighter blue. And this earnings season, second quarter of 2024, is when we finally see the rest of the S&P index, that growth return here and flip from negative back to positive territory. And of course, this is extremely important when we talk about the broadening potentially of market participation, what exactly that could signal in terms of some of the momentum, in terms of some of the leadership that we could see going forward. So that, of course, is going to be one of the focal points here for investors, for strategists over the next several weeks.
Yeah, it's really interesting because we're seeing some data from Bloomberg Intelligence as well showing that there is this expectation of earnings growth for those other 493 names, expected to post the first positive profit growth in the last 6 quarters, potentially seeing double-digit expansion by the fourth quarter in those names. Meantime, earnings growth for the Mag 7 expected to slow to just 18% in the second quarter, which is obviously a great number still, but it's about half of last year's average. My question is what we're going to start to see heading into tomorrow on some of those consumer names. Are we going to see the consumer weakness that we've heard start to show up in those earnings reports? And what does that mean for the broadening out question mark here, Shawna?
Certainly.
Well, coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks to grow your money. Hey, on today's show, avoiding potential volatility in the back half of the year, we speak to one portfolio manager who's got some advice for you and your money. And paying down debt. Our personal finance reporter, Carrie Hannon, is going to give people who are nearing retirement and still have an income the tips and the tricks you need to better prioritize your payments. Plus, money moves to consider before the Fed cuts rates. One expert going to tell us how to lock in savings rates and adjust your budget and your investment strategies to account for any future loosening in monetary policy. All that and much more coming up throughout the show. Investors, though, keeping close tabs, tracking Fed Chair Jerome Powell's testimony in front of Congress for any clues about the timing of rate cuts. And they're also anticipating Thursday's big CPI print, which could help guide the Fed's thinking around cuts. The majority of traders are pricing in a September cut. Our next guest, though, says if we see that first rate cut in September, it will likely be due more to the weakening labor market than the inflation print. Here with more, let's bring in Brian Mulberry, who is the Zacks Investment Management Client Portfolio Manager. Great to have you here with us today, Brian. So take us into your thesis here and why it would actually be more tied to weakening in the labor market versus the inflation print.
Well, to your point, just as the graphic showed before, we're not really getting close to the 2% target that the Fed has set out for a normal inflationary environment. So if that's the case, if rates are going to go down sooner than later, it's morely because the dual mandate comes back into play. Chairman Powell talked about this a couple times in testimony yesterday, where we are seeing more movement in the labor market with the unemployment rate up to 4.1% rather than prices coming down closer to that 2% target. If we just take the Fed at their own word and look at their summary of economic projections, they thought that the peak unemployment rate in 2024 would be 4.0. We're already above that. And if we were to creep up even more to 4.2, that would be the peak unemployment rate in 2025, according to their own tables. So that might becomes more of a growing concern for the Fed rather than just prices. So remember, it's full employment and stable prices are the two mandates that they're worried about. And it seems like one is advancing more than the other. And in our opinion, that tends to be weakening in the labor market, at least according to the trend in data right now.
Where do you need to see continued weakening on the inflation part of this equation, especially as we know it's been stickier in things like shelter and energy?
Yeah, exactly. Those are the really sticky things. And I'll throw in healthcare there as well. We have seen material relief in things like used car prices, and that's helping on the headline portion of CPI. But really, it's that shelter component that is so sticky right now. And we've seen kind of rolling waves of food inflation. It's gone from one category, it was meat and poultry a year ago. Now it's in things like cocoa and coffee and things of that nature. So it's been kind of a rolling target trying to get those prices to come down. Every time one category tends to go down, another is moving up to all-time highs just in terms of the pure commodities. And so that's been a difficult moving target for the Fed to try and control. So we need to see relief in other areas to try and counterbalance some of the shortages that we've seen just from the supply side alone on food.
And so additionally here, you're seeing volatility in the back half of the year. For investors trying to price that into their portfolios, what investments, the types of investments, should they be looking for?
Well, what we believe is as we've gotten to about 17% return on the S&P 500, it's a wonderful year. We'd all love to book that right now and call it a day. What a great year, what great returns. But that's really been driven by such few stocks. To your chart earlier, the Magnificent Seven account for the lion's share of that 17% growth in the index. So if that earnings is going to balance out, we feel like it's going to come from higher quality names. It's not going to be a broadening effect across all names because we are still in a very high interest rate environment. And I'm just making the case now that growth is slowing, jobs are weakening. This isn't necessarily the case where you're going to see earnings growth from every corner of this market. So you really have to be concentrated on what we think are the highest quality metrics, things like really good and growing earnings. If the S&P is growing earnings around 7%, then that would be the mark that we want to try and beat. And we want to see that done without using a lot of leverage on your balance sheet. So things like low debt levels, high free cash flow yields, and good and growing earnings, those are going to be the types of companies that will outperform their peers, but they'll also be higher quality names that are better set to handle a more volatile back half of the year. One thing I'd like to point out is just simply the lack of volatility to the downside that we've had. We haven't had a 2% down day in more than a year in the S&P 500. 2022, not all that long ago, the 5 worst days in the market were all 3% down or more. A couple of them were even 4% down. So if you think about it where we are today, that would be a 250 plus move down in terms of points shaved off of the index. I don't think that investors are really ready for something like that. We've been lulled into this false sense of security that this market is just going to keep going up forever. And as we know, most everything reverts back to its mean over time. And that's just simply what we're expecting.
Can you show us some examples of a high quality company, and on the other side of the spectrum, perhaps a non-high quality company as well here? Because I think a lot of people are just trying to wrap their minds around what this actually looks like as they're combing through some of the earnings reports that are set to be coming out this season.
Absolutely. And this is an incredibly extreme example, but it really frames the discussion, I think, quite well. When we look at a high quality name, JP Morgan is one of those that's at the top of the list. It fits those metrics that we just laid out very nicely. We're talking about a company that is going to grow earnings around the same amount as the S&P 500. And that's a little bit unusual for a bank to be able to keep up pace with the broader market. 7 to 9% earnings growth over the next 2 to 3 years. We're talking about a company that has a PE right now of around 12. So it's actually a great valuation compared to the market at over 20 times earnings on a forward basis. And then we're looking at things like cash flow yield, 11%, of 1.6 trillion of cash on hand, and very low levels of debt and low short interest. The short interest on JPM right now is under 1%. So this is a high quality name that is built with cash flow and scale, that is built to handle any type of downward pressure. They have really good levels of liquidity. They just passed a stress test with flying colors. And this would be the high quality type of name that I would want to own in the back half of this year, knowing that it already has had pretty good returns on a year-to-date basis. It's not quite as good as what we've seen from some of the other names in the benchmark. And again, a PE of 12 tells me that this is still a good buying point for this type of a name.
And what about on the other end of the spectrum? Yeah, you were about to go there.
On the other end of the spectrum, you have New York Community Bank. They got dealt a hand where they absorbed, obviously, the liquidating assets from Signature Bank, but they haven't handled that very well. This is now a name where we're seeing very poor quality metrics, where we have a negative cash flow yield of around 85%. We're seeing very low levels of liquidity, very low reserve requirement. They're under a lot of stress, according to that recent stress test as well. And so this is a type of a name that, as rates stay higher for longer, is going to continue to struggle to grow earnings and revenue and keep up with that monster debt load that they're trying to manage at this point in time. So if there is pressure on the broader market in a down type of a cycle, this would be the type of name that would probably be down more than the market and expose your portfolio to greater loss potential.
Brian Mulberry, who's the Zacks Investment Management Client Portfolio Manager. Excellent breakdown there, Brian. Great to speak with you here this morning.
Thank you.
Certainly. Well, Fed Chair Jerome Powell is currently testifying in front of Congress for a second day as part of a semi-annual monetary address. Today, he's in front of the House Financial Services Committee. Powell was asked whether greedflation, or the idea that businesses keep prices high to boost profits, had anything to do with persistent inflation. And here's what he had to say.
We look at it that this inflation has been caused by a combination of, very strong demand and constrained supply.
So there's no data that supports that gouging of consumers is part of the inflation.
It's been very hard to track a connection with, earnings and things.
Now, on Tuesday, Powell opened the door for the path to an interest rate cut this year when he told U.S. lawmakers during this procedure that's going on, the testimony, that he was encouraged by evidence of cooler inflation and that more good data would help get the Fed to where it wants to be. He also said that the latest job market data signals conditions have cooled considerably and that the risks of bringing down inflation and cooling the job market are more balanced. Coming up, everyone, on the other side, the high costs of housing. We'll break down how America's housing crisis extends beyond a shortage of homes and into the labor market. That's next.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
There's no question that inflation and the cost of living is a big pressure point for many Americans, but one group is severely being impacted, and that's low-income workers. The shortage of low-cost units makes it more difficult for minimum wage workers to secure affordable units, especially in desirable neighborhoods or metropolitan areas. Now, here to weigh in on this issue, let's bring in Catherine Ann Edwards, who is an economist and policy consultant here. Great to have you on this very topic. I mean, how much of a crisis are we looking at for affordable housing at this juncture?
It's hard to put it into historic terms because when you can't find housing, it's a crisis, right? If you're a family who can't find a good place to live for your children, if your wages, you work full time and you can't afford a place to live, it's a crisis for you. So it's hard to say to what extent it extends through the economy, because most people find a way to make do, even if that's paying 50 to 60% of their income to housing. What we know is that the number of affordable units is falling in the US, and that wages at the bottom are simply not growing to keep up with the housing market.
And when we think about this too, I mean, of course, there's always, typical New Yorker thinks about this applied to New York, right? So as I'm thinking through this, there are so many jobs, especially where people who want to be able to stay and live in New York and perhaps have even been grown and raised in New York, now are trying to figure out, okay, if I can't afford here, then how does that change the living situation so severely to the point where now I'm adding on hours of commute, or I'm commuting in from some area outside of the metropolitan area? So how is this also kind of correlating with what we're seeing on the wage front right now? Because that is the bigger issue here too.
So the, housing affordability is about price relative to income. And a lot of our conversation about housing affordability has been about price, which we can move through supply. We need to build more affordable units. We need to build more high-end units. We need to build more units across the United States. And in overcrowded metro areas, we need to build more. And that should help stabilize prices. And, the inflation crisis that we have right now has lent a lot of kind of lens and spotlight on housing prices, because they seem to be keeping inflation from falling at the level that we'd want. But the income side gets so much less attention. The minimum wage right now is $7.25 an hour. If you work every hour of the year, you can afford $377 a month in rent. There is no amount of housing supply that is going to create a $377 a month apartment in almost every single metro area in the US, including most rural areas. So the supply side requires a portfolio of options: multifamily, low income, high income, single family, low income, high income. But the income side, the wages, really comes down to why we have structured our labor market to produce so many working poor people.
It's really interesting. I think about kind of my own situation. I live in an apartment where, honestly, if they were charging me the real market rent, the market rate, versus what they're actually kind of saying, hey, you just have to pay this, I probably wouldn't be able to live in that apartment, quite frankly, here. So, and there are a lot of people that are in that situation. Does there need to be an adjustment of market rates across the board? Because that's actually not accounting for what people are really paying and what the actual demand profile looks like.
Yes. I mean, there are so many good housing policies out there that we haven't pursued. We could do more for the low income housing tax credits. We could do more for, quality assurance in housing, helping renters at all income levels. And I think of a lot of people who feel, basically lucky to be in the place they're in, that feel like they are below market, and they, not to point fingers, but they are their own type of problem, because they are taking affordable units off the market and basically sitting on them. And I think this is most often brought up with homeowners who are at, they got an interest rate in the pandemic that was below 3% on a 30-year mortgage. They don't want to move and go to a 6.5% rate somewhere else for a more expensive home. So the supply side requires, more than anything, lots of movement for homes to be available, for people to be able to take advantage of the market. But the income side is a much more pernicious problem, in that it doesn't have this ready option of solutions that we can immediately start to pursue. How do you get rid of the fact that the United States has one of the largest shares of low-wage workers out of any country in the industrialized world? Nobody pays people as little as we tend to pay people in the U.S. So yes, there's lots of ways to unlock the housing market through more supply and more movement. But how do we generate better incomes at the bottom? Housing just offers us a lens to think about kind of how our economy produces income.
And so within that as well, it might come down to where the jobs are located. If we continue to see such a concentration of corporations near or adjacent to major cities, then that's also not facilitating some of that very movement that you're talking about, I would suppose, as well.
Yes, but you want companies to make decisions, not based on housing, right? We want them to make decisions based on supply chains, based on intellectual and human capital, based on, convenience to how they do their business. We don't want housing to hinder businesses, and that means we need to have lots of movement. That means we have, not a lot of lock in the housing market. We don't want people to be locked into homes, because if they move, they'll never be able to afford another one. That requires a thriving, functioning, well-supplied housing market. And let businesses make business decisions that are best for them. The question of low-wage workers and low-income Americans comes down to labor policy, right? What do we think the minimum wage should be? Because it's been $7.25 since, I was in high school. What do we think labor law should look like? Should it be enforced? We are in a renaissance of child labor right now. That is a policy decision, not a business decision and not a personal decision. That's a policy decision.
Yeah. Oh my goodness. Yeah, it was something around $5 when I first started my first job, and my dad made me ask for minimum wage when I went in there. So $7 sounds quite attractive, but it's not in today's terms, to your point, at all, and not sustainable. Just lastly, while we have you here, when you think about the number of people that are looking for housing, maybe renting, maybe looking to own even one day, I was looking at the stat from Redfin that buyers need to earn $114,000 to afford the typical U.S. home. That's 35% more than the typical household makes here. I mean, these are improvements, but it's still not nearly where the dial needs to be at, or the correlation needs to be at, in order for households to feel like they're not falling behind here as well at the end of the day.
Yeah, and I appreciate you bringing that up, because I think, when we focus on things like inflation in financial markets, we're looking for that short-term measure of gain, right? Once rents go down enough that CPI falls with it, then we get the interest rate cut and we get to declare victory. But most U.S. households cannot declare victory over the amount of money they are spending either on their rent or on their mortgage, even after CPI moves enough for us to feel like we've won over inflation. So I think it's critical to bring up this idea of affordability for Americans, and just this fundamental disconnect between how much people earn and how much housing costs. That will not go away even when we get a good CPI print. And I think while we have this attention on housing affordability, coming from this big national question on inflation, this is the time to think creatively, and it's time for policymakers to act. What I try to bring up is that there are probably 20 pieces of legislation in Congress right now of ways to increase housing supply, increase housing affordability, and get movement in the housing market. There are almost no policies of how to generate income and better labor law at the bottom.
Wow, that's really important to point out here. Catherine Ann Edwards, Bloomberg economist and policy consultant here. Thank you so much for taking the time here with us today. Really appreciate it. Important conversation.
Thank you for having me.
Certainly. A growing number of consumers at or near retirement are in debt, and paying off debt while being retired means you might need to tighten your belt and prioritize your spending. To discuss, Yahoo Finance's very own Carrie Hannon is here. Hey, Carrie.
Hey, Brad, good to be here with you this morning. Yeah, this study that I looked at today is showing that more retirees, over a quarter of retirees, are retiring with debt, mortgage and credit card debt. And this is really concerning. Common wisdom says, do not retire with debt. Give yourself a fresh start, because you're going to have lower income in retirement and so forth from your retirement accounts. So this is troubling. And the report, it's from the Nationwide Retirement Institute, also showed that retirees were dipping into their retirement accounts at a faster clip than they had originally planned to. And this is really concerning for long-term financial implications if you've got 3 decades to support in retirement. So that sort of sets the stage for something that a lot of people need to be paying attention to. And so, it really does is a bit alarming, I would say.
So what tips do you have for people nearing retirement?
Yeah, Brad, there are things you can do. And so the very first thing is, as you said at the top, rein in your spending. Really get serious. You do not need, until you can clear some of this debt from your books. If you figure the average credit card interest rate right now is 24.8% if you're revolving your credit. This has got to go, or you are going to really put yourself in a hole. So rein in your spending and take control right now. Yes, you can tap your retirement account if you're over 59 and a half, and you're not going to have a penalty for that. You will pay the tax on it if it's a tax deferred account. But for some people, that might be the solution. Of course, as you know, there's it's not a one-stop shop here. There's no one solution that's going to fit everyone. The next thing, and this is one of my favorites, is keep working a little bit longer. If you can stretch out, whether it's even a part-time job, so that you can whittle away at this debt and not touch that retirement account, that would be absolutely ideal. Now, it's important to run your numbers. Some people really just don't want to think about it. So, make yourself sit down, write down what debts you have, what are the interest rates on these debts, and start ticking them off. Start with the highest one first and work your way down. And frankly, you can often call up your credit card company and negotiate for a lower interest rate. At least give it a shot. It actually does work. The other option, and we talk about this a lot when we talk about credit cards, if you have that massive credit card debt, then see if you can switch to a balance transfer card that has zero interest for maybe 21 months or so. Give yourself a respite and take a breath. You might have to qualify for these. There's a small fee to do it, but it's often a good opportunity for people to get their legs under them.
Carrie Hannon, great tips as always. Thanks so much, Carrie. Appreciate it.
Thanks, Fred.
Certainly. Everyone, we've got much more wealth after the break. You're watching Yahoo Finance. Actively managed exchange-traded funds account for 33% of all ETF inflows this year through May. That's despite representing just 7% of all ETFs, according to a report. And our next guest thinks that they might be the best play for an uncertain back half of the year. And to discuss this further, let's bring in Cynthia Murphy, VettaFi investment strategist, as part of the ETF report brought to you by Invesco QQQ. Cynthia, Great to speak with you. Great to catch up here once again. All right, so break this down for us. Why do you think that these are the most in-demand active ETFs for the second half of the year?
Hi, Brad. It's been a big year for active ETF demand because it's a time when people are trying to be more hands-on about positioning themselves in this amount of uncertainty going forward. If you look, the demand for your classic index-based portfolios, whether it's in equity or fixed income, that remains strong and really robust. But active is a little bit of a new phenomenon in the ETF space. It's been around forever, but it never really took hold until recently, when more product, better product, lower fee products really started to emerge. So we've seen not only a huge amount of launch of interesting strategies, things like in categories that didn't exist before, like buffered investing, or a lot of options-based equity income, things that we couldn't do it before in a lot of the index-based strategies. All these things now exist and they're accessible from a price point perspective, and we're just seeing investors really embrace it as a way to either diversify portfolios or to look for alternative income strategies or better risk management tools, all of which apply in an environment where we don't know where this market is going.
We were speaking earlier with one of our guests, Brian Mulberry, who was telling us about this flight to quality. How are we seeing that play out in the ETF landscape?
Yeah, the flight to quality is interesting because it speaks to sentiment. So at VettaFi, we recently did a poll where we asked advisors, how are you feeling about the second half, bullish or bearish? And a higher percent of advisors said they feel more bearish going into the second half than they felt more bullish. And you're seeing that expressed in a demand for, quality. So for example, if you've really been in this growth train and you're just buying up your Nvidias and your Microsofts and your Apples and you really chase the Mag 7 and you're all in, all of a sudden you're worried about, can they keep delivering on these earnings? Can they keep delivering surprises to the upside? Or is it time to really focus a little bit more on quality? So funds like Q Grow, for example, really stand out as you stay invested in growth, but you're really looking for fundamental quality in some of the names. We've seen demand for things like, free cash flow companies that's a suggestion of a sign of financial well-being. So funds like VFLO, VFlow, or some of your cash cows also stand out in this space. So the flight to quality has been happening both in equities and in fixed income, again, as a safety guard, as a little bit of a defensive positioning ahead of what comes next.
We were also, and I'm just having all of these little kind of remembrances of conversations that have had some of the very themes that we're talking about, but within some of the kind of larger realms of what thinking investors may be going through right now. And one of them that came up was GARP, growth at a reasonable price here. How does that play in over an ETF strategy that someone wants to roll out as well?
Yeah, there are a couple of interesting funds in that space. One, the ticker is GARP. The other one, DARP, D-A-R-P. These are strategies that, again, they want to keep you invested in growth. If growth is your thing, if you just think classic growth versus value, and you really want to lean into growth, but you are worried about valuations. I mean, valuations are really stretched in the space, but leadership has been very narrow in this space as well. So when you go to something like a GARP, you tend to find names that aren't your Mag 7 so heavily weighted. You tend to find things that are they're fundamentally strong, they're growing businesses, but they haven't been big headliners, so they're a more attractive valuation. So it's almost like introducing a valuation screen to your growth play, which again is a bit of a safety guard, and it's something that is starting to appeal to a lot of folks who they don't want to give up on the gravy train of growth because nothing has suggested anything breaking there yet. I mean, momentum has slowed down in growth, but they want to stay invested in that, but they're just taking a more precautionary tone with some of these, valuation metrics introduced there.
Cynthia, always a pleasure to get some of your insights, and thanks so much for joining us here on the show today. Really appreciate it. Cynthia Murphy, who's the VettaFi investment strategist, joining us here on Wealth. Thanks so much.
Thank you so much.
Interest rates are high, but maybe not for long. We break down money moves that you might want to consider before and after potential rate cuts. That's right after the break. The chances of a September rate cut are growing. Over 74% of traders are betting on one at the upcoming September Fed meeting. But do you know what to do with your money if cuts actually come? To discuss, let's bring in Leslie Tane, who's the Tane Law Group founder and head lawyer here with us. Leslie, thanks so much for taking the time and joining us here on Yahoo Finance. So what should people do? They see that first interest rate cut finally come through. Fed Chair Powell takes the lectern and says, here's why we did it, and here's what the pathway going forward looks like here as well. But a lot of people still trying to figure out how not to fight the Fed, but anticipate what they're doing.
True. If the Feds do cut rates, it's something to keep a watch on. As a consumer, these are important numbers. When the rates come down, there's lots of opportunity for borrowing. So at this time, if you're looking for to borrow certain monies, like in the housing market or otherwise, you might want to hold off larger purchases to see if the rates actually come down. If the rates come down, and the converse to that is if you have savings and CDs. When the rates come down, your savings account rate will come down, the same with CDs. Now might be the time to lock in higher interest rate on savings accounts and CDs.
When's it time to refinance? When those rate cuts start to come through, a lot of people are going to be sitting on the edge of their ergonomic chairs trying to figure out, okay, now do we refinance or do we wait for later rate cuts?
No doubt it's the time to watch it. If you have taken out a mortgage or a high interest rate debt over the last year and a half when interest rates were at their highest, it is the time to watch the market to see when to pull the trigger on the refinance. Those that have great rates from several years ago at 3% or hovering around 3%, now still would not be the time to refinance that. But as the rates come down, you definitely want to watch the market because a quarter point may not make a difference in the refinancing. You want to look for larger rate cuts or additional rate cuts as time goes on. It's possible we may see a 0.25% rate cut by the end of the year. So coming in the new year in 2025, that's the time to watch the Feds and see what's going to happen in the upcoming year.
Certainly. When you think about how people need to potentially adjust their budget, what type of considerations should they take into account?
You want to consider your budget at all different times. Rate cuts is another time to relook at your budget. Savings accounts, if you're living off savings or investments and the interest rates are going down, then you may find that you don't have as much income. Borrowing can increase during that time because the rates are down, so it does encourage those consumers and businesses to start borrowing and spending. So that's the time to see, well, in my budget, where do I need to be to purchase new items, even everything that might be considered something on credit, from cars to houses and even your savings. So it's important to be looking at your budget on a regular basis, especially if your budget and your income is impacted immediately by rate changes.
And then just lastly, Leslie, while we have you here, some of the large purchases that people might put back on the docket or at least start kicking the tires on, both literally and figuratively, I guess, in some cases here, how should they be really running the calculus on when to make those purchases?
Some of it is based on need and timing. If you understand, let's say you have a car that's at the end of its life or lease and you're looking to refinance or purchase a new vehicle that you're going to buy on credit, it's the time to be watching that and saying, how long can you hold off doing that? If you have a low interest rate to begin with on vehicles or other interest-related debt, then you want to hold on to that as long as possible without refinancing. Remember, there's always a cost to refinancing and buying anything. Borrowing money comes not only with the interest rate, but the cost for borrowing money. So if you have low interest rate on some revolving credit or on secured or unsecured debt, you want to make sure that you hold on to that. If you have high interest rate debt on that, you want to start thinking about when is the time to pull the trigger, when do you actually need to do that and are able to actually do that.
Leslie Tane, who's the Tane Law Group founder and head lawyer. Thanks so much for taking the time with us today, Leslie.
Thank you for having me.
Certainly. Everyone, global wealth is increasing, but by how much? UBS is out with their annual global wealth report, and while wealth is increasing worldwide, its pace is slowing down dramatically. As the report points out, in the first decade of the millennium, over half of the markets in the sample saw their wealth grow in the double digits when measured in US dollars. Since then, not a single one comes close to 10%. For more on this, let's bring in Paul Donovan, UBS Global Wealth Management Chief Economist. Paul, great to speak with you, and thanks for taking some time here with us. What do you think is at play more largely with some of the wealth growth dynamics here? And is there one major catalyst for the wealth growth that we have seen?
So I think the major catalyst behind the slowdown is simply that as we become wealthier, as economies move out of low-income status towards middle-income status, naturally the pace of wealth accumulation is likely to slow. If you're a very low-income economy to start off with, you're getting rapid wealth increases is actually quite easy. But if you're a relatively mature economy, like, say, Europe or the United States, you're not going to get that double-digit growth coming through. Also, it's worthwhile pointing out, we've had the aftermath of the global financial crisis. We've had a global pandemic. That would naturally cause some slowdown in global wealth growth in the second decade of this millennium.
We're certainly looking across some shifting dynamics of where there is major purchasing or what industries are seeing booms right now. It's hard not to think about generative AI and some of the chip manufacturers that are really benefiting. So how has that also kind of passed through to certain regions of the world and their own kind of wealth growth?
So this is something that is actually very, very important. It's one of the reasons why trying to get a handle on what's happening with wealth, which of course is what we've been trying to do for the last 15 years, why this is so important. Because when we get these periods of dramatic structural upheaval in the global economy, what we call the fourth industrial revolution, what you will find is that certain individuals, certain companies suddenly get wealth, unexpectedly get wealth, almost by accident. You just happen to have had the right idea at the right time and boom, off goes your wealth. So when you see these sort of disruptions coming through, it's very common that we get very specific wealth increases coming through, either because people have invested in the right companies at the right time, or they are entrepreneurs who have just happened to have the right idea at the right time.
And so with that in mind, where are we seeing kind of the biggest slowdown right now?
Well, slowing wealth is tending to be more likely where you've got slowing population growth or negative population growth, and where you are a relatively mature economy overall. That's where you're more likely to be seeing a slowdown in growth. We've got to bear in mind that wealth is something which is generated by people. If you've got fewer people in your country, then at the very least, the growth rate in your wealth is likely to be lower, and it could well turn negative. So you look to some of the older economies with very rapidly aging demographics. That's where wealth is more likely to be slow or very occasionally negative.
So I guess as a follow-up to that, because millennials get blamed for everything and population growth could be another one of those things, what kind of pass-through effect would that have on wealth growth in the next decade even, if there wasn't, the family planning or the population growth that we've seen of decades past?
Well, I mean, whether we're talking about GDP, which is an income measure, or wealth, which is sort of effectively an accumulation of past income, you will see a slowdown. But not necessarily, of course, in wealth per person, or for that matter, in GDP or income per person. And so this is one of the interesting things about the millennials. That people say, millennials are going to be worse off and they're not as well off as their parents. Millennials will be one of the richest generations we have ever had in history. Because what is going to happen is you have got still growing wealth. Wealth has grown for 12 out of the last 15 years in the global economy, but you've got fewer people to divide that wealth up amongst. So the millennial generation, because it's a smaller generation than Gen X, my generation, or the boomer generation, because millennials and Gen Z are smaller generations, they will be sharing a larger pot of wealth amongst fewer people.
Paul Donovan, love to hear it. UBS Global Wealth Management Chief Economist, thanks so much for the time, Paul. Great to see you.
Thank you very much.
Certainly. Coming up, everyone, Caitlin Clark, Angel Reese, and other young stars helping supercharge the popularity of the WNBA, plus some very good vets along the way, of course, I will mention. I'm going to dive into the outlook for the league with the president of a brand new team. That's next on Wealth. The popularity of the WNBA has exploded this year in a great way. According to the league, more than half of all WNBA games since the start of the season through the end of May were sellouts, which is a 156% increase from last year. And when it comes to watching at home, across all channels, WNBA games are averaging 1.32 million viewers. That is nearly triple last season's average. Now the league is getting its first expansion team since 2008. The Golden State Valkyries will begin play in the 2025 WNBA season at Chase Center, and joining me now, we've got Jess Smith, who's the president of the Golden State Valkyries, joining us here on Yahoo Finance. Jess, great to speak with you. Congratulations. I mean, I imagine there's like a Gantt chart of all the things that need to be done between now and May 2025. Where do you sit within this kind of broader range of things that needs to happen, and how excited about bringing this to life are you?
Yeah, this is so much bigger than Golden State. That Gantt chart is astronomical, but it's a privilege to be able to work off of that. You know, right now, there are many things that are priority for us, but certainly building our fan base, bringing people together, understanding what the power is that we have the opportunity to build is top of mind. You know, the Bay Area is a region that often leads the world in both being progressive and innovative. This is the region where people look to see what comes next. And for us at this moment in time, what you just referenced with WNBA growth, we get an opportunity to harness that through one of the best basketball legacies, you know, that exists today. And to do that through women's sports and through the incredible athletes of the WNBA is pretty phenomenal. So we have close to 15,000 season ticket deposits right now. We're working through, you know, those folks, bringing on our partners, but most importantly, thinking of team strategy and what that's going to feel like for our fans in 2025 as well.
Slight tangent for a hot second here. What was the inspiration for the team name?
That is a great question. That name actually was fan-led. So when the team announced the expansion, you were showing some of those images when I came on camera, the San Francisco Chronicle here locally actually ran a fill in the blank, what should the team name be? And 25% of people wrote in the Golden State Valkyries, which is just an insane amount, right? 1 in 4 people actually calling for that name during that survey definitely put it on the map. When you think of the Valkyries, you think of, you know, it's a female warrior, right? So it's certainly a nod to the incredible Golden State Warriors and being a part of that organization as well. And yet it stands on its own. That modern depiction of a warrior is relentless in their pursuit of doing what's right, and certainly has the ability to go out there and win with an attitude that way too.
I love that. You know, I also love seeing some of the new fanfare that has been brought to the league by the latest draft class. You think about Caitlin Clark, you think about Angel Reese, and adding them to the list of names that were already so successful within the WNBA. Names that some of them I grew up watching as well, and that still have so much longevity within the league. I got to know if you get that first draft pick, and of course what you intend to do with that first draft pick for the franchise here as you build out your own team.
Yeah, for us, we're going to have players beginning in December. So we have the expansion draft that will happen in December, followed by free agency, then followed by that college draft. What you said is exactly right. This new audience following these incredible athletes in draft classes is just the beginning of what you're seeing. This was year one. Next year is going to be just as exciting, and so forth and so forth. You look at the freshman class right now that just wrapped up their year in the Hannah Hidalgos and Juju Watkins, et cetera. Like it's no end in sight when you think of just exciting talent funneling into this league, to your point, to complement the incredible veterans here. But for us, you know, we need to win. You know, Joe Lacob made that very clear when the team was announced that he expects a championship in the first 5 years. And so our incredible GM in Ohema, who joined us most recently from the New York Liberty, that's what she's hard at work on. How are we going to piece this culture together through having existing players and certainly a new player through that draft, build a legacy, you know, that all of us can be proud of and work against.
Jess, you mentioned some of the amazing crop of future stars for the WNBA that are currently in college or currently playing abroad. And you mentioned Juju. I mean, look, I follow Juju as well on social media, and a lot of the college players are able to earn so much in NIL that they're almost able to kind of put off coming into the WNBA. You know, how do you attract that next wave of stars to say, hey, build on the success that you're already seeing, and, you know, maybe don't prolong your college career, come to the WNBA, bring some of your know-how on and off the court, and we can all elevate this game together?
Yeah, well, first, that NIL money doesn't go anywhere when they come into the WNBA. So often you're seeing that actually increased as they're coming in. Super talked extensively about this, with Page backers as they were kind of analyzing some of that narrative that's out there. Secondly, the rules are different when you can enter the WNBA. So it's actually not a one and done like the NBA. They do have to be in college for more years or older before they have the ability to join the league. So right now, it's actually working, I think, in everyone's favor for the NCAA and the WNBA to continue to see and harness that star power. And then when they enter the league, what you're seeing happen right now is that impact of the Cam Brinks, the Caitlin Clarks, the Angel Reeses, et cetera, where those are household names that people have been cheering for and can't wait to see where they go when it comes to draft day.
Certainly. Just lastly, while we have you here, Jess, I got to hustle to my finish, but what are some of your top tips for female athletes negotiating their pay packages and trying to make sure that they're getting the full worth that they have?
The biggest consideration in all women's sports right now is understanding and watching it become the product that it is. And it's different than men's sports. This product is a mix of sport and purpose and pop culture, and making sure that it is creating platforms around that the content reflects that it's more than just media is really, really important. So certainly it's about negotiating, but you also have to create what that is to ensure that that brand value, whether it's for yourself, your team, the league, can translate to the brands that are looking to spend those dollars. At the end of the day, we have to prove that ROI, but our value set and what we're telling society and with that impact is certainly a big piece of that.
Jess Smith, president of the Golden State Valkyries. We can't wait for the inaugural season here. Of course, we gotta finish out this great WNBA season that is going on, and of course, we got some Olympics that are coming up here too. But really excited to hear what's coming on the front and next to Golden State. Thanks so much for taking the time.
Thanks for having me. Go Valkyries.
Absolutely. That's it for Wealth, everyone. I'm Brad Smith. Thanks so much for watching today. Stay tuned for Market Domination with Julie Hyman, Josh Lipton. That comes up at 3 p.m. Eastern Time. You don't want to miss it.